Okay, hello everybody and welcome to the Trade Guide Systems International Foundations course, The Foundations of Volume Spread Analysis. My name is Gavin Holmes. I'm the author of Trading in the Shadow of the Smart Money, and I'm just about to publish my third book, which is coming out in late December, and we'll talk about that later. But this book was written as a result of a meeting that changed my life. 10 years ago, in fact nearly 11 years ago now, I met a man called Tom Williams. And Tom Williams, who you'll hear about later, was formerly a syndicate trader, which is basically, I would suppose you'd call them now, a large institutional hedge fund. But in those days, we're talking in the 1970s, they were called syndicates. They were large groups of professional traders that got together and pooled their money together and were able to specialize in certain instruments. So for instance, in Tom's day, Tom's trading syndicate would specialize in trading just 12 US stocks. And their whole goal was to control the stock to their benefit. You might use the word manipulate, but whichever, I can assure you, with large amounts of money out there, there's some very clever individuals who know how to make money in the markets. So we've put together a course, and this course is called the Foundations of Volume Spread Analysis, or the Foundations course. It's going to involve 3 days that you're going to be with me. This is today's session, and today we'll be doing 2 sessions, each lasting about 90 minutes, and we're going to go through some of the basics. We're going to look at how to build a chart. We're going to use the Trade Guide software, which I currently use. But if you've got one of our plugins, or even if you haven't got the software, you'll still be able to benefit from this course, because we're going to talk about some very basic key principles of how the markets really move. Now, the markets do not move by accident. Okay? A lot of people think that there's accidents. You know, oh, the S&P fell yesterday, and the newspapers report why they think it happened. But the only thing that moves the market is the trading of what I call the smart money. Who are the smart money? Well, I define them as large institutional banks or individuals with large capital accounts that think nothing of trading 5,000 contracts in gold, silver, whichever. You know, there's so many different markets you can trade. Now, I happen to be going into business with one of those traders. We are starting a hedge fund here in the United Kingdom. And one of the traders that is going to be running that fund with us is the 4th largest gold trader in the world. And he's using volume spread analysis. And he and I are forming a hedge fund, which won't be public for about a year. It'll be a private fund initially. And we're going to be auto-trading some setups that I'm going to teach you this morning. We're going to show you the importance of what I call the end of a rising market and a shakeout. Both of those signals are really the best way to make money in the market. Because a shakeout, as you're going to see, happens when the news is bad, when everyone's panicking. And yet, funnily enough, if you look at the biggest shakeout that I've ever seen, it happened in 2010 in a stock called British Petroleum, BP. And the news was horrific. The news was so bad because we had an oil spill in the Gulf of Mexico. And yet I looked at my chart, and on the day it was widely reported that they couldn't cap the well, the volume on the chart was the highest for 12 years. And I looked at my chart and I said, they're buying British Petroleum. The smart money are buying BP. And as I'm going to show you later, it was proven to be right. But even I didn't believe my own signal. Even I didn't want to get in and buy at that point because the news was so bad. I was fooled. In fact, I remember ringing Tom Williams. I said, Tom, I've just heard that Colonel Gaddafi is going to take over BP. This is what the news was reporting. And Tom said, Gavin, look at the chart. The chart doesn't lie, Gavin. Look at the chart. There is a shakeout. The professional side of the market are buying BP stock at $25. Well, it was only a week later I went and did a presentation at the Massachusetts Institute of Technology, MIT, in Boston, to the Boston Traders Group. Great bunch of people. And one of the traders at the end said, Gavin, that's a great presentation. Thank you very much. But could you give me a stock now that's very likely to go up? And as we'd seen a lot of accumulation, which we'll talk about later in the background, I looked at the chart. I said, well, look, I said, I have to show you British Petroleum. And they all started laughing. They said, we all sold that. I said, I know you did. I said, but someone's buying it back at lower prices. And they said, no, BP's going out of business, Gavin. We watched CNN last night. And I said, well, hold on a minute. Look at the chart. So they went and looked at the chart. And only 2 out of nearly 116 people who attended that event went out and bought BP at $25. And what happened? Within 6 months, it was trading. It was nearly double in value. Now, I'll show you the chart later, and I'll show you why that happened. And BP, as a stock, has started to pay dividends again. So it's a very good stock to hold on to, and it's one of the stocks that I specialize in. So I wrote my book called Trading in the Shadow of the Smart Money. That's me. And it says here in 2002, Gavin Holmes had the good fortune to meet Tom Williams, a former syndicate trader, who in his early years had traded with one of the largest stock trading funds in America at that time. Tom subsequently wrote 2 books, The Undeclared Secrets That Drive the Stock Market and Master the Markets, which are read by more than 100,000 traders and investors worldwide. In fact, it's a lot more than that now. Gavin was introduced to the book's author, and at their first meeting, Tom explained that the markets were being manipulated on a daily basis by the smart money. Tom Williams had been a smart money insider and later developed trading system software to discern the activity of the smart money manipulation of the markets, www.tradeguider.com. Gavin later became a Williams protege, and since 2001 has become recognized as a leading expert in market manipulation and the volume spread analysis methodology. And it talks about there my passion to teach. I love doing what I do, and I hope you'll detect that. I really enjoy doing these courses, and I really enjoy people who email me weeks or months after the course to say, hey Gavin, look at this trade I made, X amount of money. I finally get it, the light bulb went off. So I have one key objective personally for this Foundations course, and that's to teach you how to profit by understanding why the markets are manipulated and how then to identify the footprints on a chart to trade in harmony with the manipulators. Now let me just be very clear. For those of you who don't know about my background, I'm a former police officer. So I'm not a conspiracy theorist. I'm not particularly contrarian. And I must admit, when I first met Tom and he told me that the markets were rigged, I said, listen, Tom, I've got friends in the City of London and we've got regulators and, they stop all that. Well, Tom said, you go and have a look at these charts, Gavin, and I'll prove to you that what you think is going on isn't all as it seems. And he showed me a chart of the markets after 9/11, okay, so back in 2001. And he said to me, look, what do you think happened to the markets after 9/11? I said, well, they collapsed. They collapsed. I said, I remember it. The markets opened, and I remember the news, Tom. And the news was George Bush and Tony Blair were on television, grimly looking at the cameras, telling us that Al-Qaeda were possibly in London and in America, and this was going to apparently affect the stock market. And sure enough, they went to the New York Stock Exchange floor, and there was the camera pointing down at the lady on the floor, and she looked up and she said, yes, everyone's selling today. Everyone thinks the market's going to collapse. But then Tom said, now look at the chart, Gavin. And he showed me a chart. And I looked at the chart, and there's a giant volume spike the day that the market opened and the second day, because it was closed, if you remember, for 6 days. Very unusual for that to happen. And the market had indeed plummeted. No doubt about it. It had gone down. But when he showed me the chart, I noticed that the next few weeks the market went up, not down, and continued to go up. And as we now know, it actually turned into a mini bull run. It went up for about several months, 7 or 8 months, before it went back down again. So professional money must have stepped in and bought at that time. And if you had, you would have made a lot of money. But of course the news would not be your friend on that day. So we're going to learn some basic, sorry there's a spelling error there, but it should say some basic VSA principles, and then put them into context to include background and trade setups. To learn how to identify the highest probability low-risk entries. Now, there are a lot of different entries that you can take using VSA. There's lots. I'm going to focus in the foundation course on what I call the highest probability. They're called my grade 3 trades. I have a trading plan that we're going to go through next weekend, And the trading plan is very important to the foundations of a successful trader. Let me ask you all, just type in yes or no. How many of you here have a written trading plan? A written. Be honest with me because it'll help me. Just type yes or no. How many of you here have a written trading plan? Just type in yes or no. You'll remain anonymous. I'm not going to read your names out, don't worry. So how many of you here have a written trading plan? I'll give you a few seconds just to type in. Okay, so far not one person has said yes. I've got one person who said sometimes. So far everyone has said no. That's amazing. I'm stunned. I'm stunned. Well, one of the things you'll learn in the course is that without a written, confirmed trading plan, you are trading blind. And you may well be going in circles in your trading. And if that's the case, then this course is definitely going to help you. So we're going to learn the concept of market manipulation and how to profit from it. And I say there legally and ethically, and that's what I mean. To learn chart reading skills incorporating volume. To understand the term the herd and weak holders. I don't want you, when you leave this course, to fall into either of these categories. I want you to avoid being a herd trader or a weak holder. We're going to learn my favorite signal, the shakeout, and how to recognize it. It's a profitable maneuver for professional money, and it can be very profitable for you if you recognize it. And I'm going to show you some examples. We're going to learn to identify the VSA patterns as they appear and be patient to get the best entry. That is something that's in my trading plan, patience. I've written about it in my first book. Most people that lose money in the market do not have patience. They're not patient people. And they want to just be in the market for the sake of being in the market. That will destroy it, without doubt. Markets move at all times. When they're open, they're moving. There's buyers and sellers interacting. But there are certain patterns that will give you much higher probability entries. All VSA patterns seen in hindsight must have been there as they unfolded in front of you. So whilst we can look at charts in hindsight, you'll note from my YouTube videos, if you've seen them, and please, if you haven't seen them, go and have a look. You just type in Trade Guider into YouTube and you'll find them. I do a lot of trade descriptions before the trade actually materializes, because you can predict a market. There's no doubt about it. You can certainly predict it. You can certainly trade it, but are you going to be 100% right? No, and that's because of something called timing. When you take a trade in the market can go against you, even if you're absolutely right about the direction of the market. It happens to all of us. I'll give you an example. There's something called an upthrust, which I'll teach you that particular pattern. And that means if the market's been falling and you've gone short, so you know that market's going down, and you've got to stop, suddenly, just as you've gone short, you see the market shoot up. It spikes up, takes your stop out, and you think, what the hell happened? The market was going down. And suddenly, the price bar closes on the low, and the next bar takes off further down. You're no longer short. You've been taken out your trade, and that market continues to fall. I'm going to show you how you trade that. The upthrust in a downtrend is a magnificent trade setup, one of the best. In fact, we've been seeing a load of them recently. It's very, very profitable if you know how to trade it. So the other objective here is to get your questions answered about specific issues you're having with your trading investing and gain confidence in your chart reading ability. To understand supply and demand and the effect the imbalance of these things have on the chart. To learn from other like-minded traders, which is why, again, I'll repeat, I do encourage you to type in questions when you're not sure about something. Again, there, understanding the upthrust. Where do you place a trade after you see this? This is what we call an SOW, a sign of weakness. There are two things you're going to learn about today. SOS, sign of strength. SOW, sign of weakness. That's really what the core of VSA is all about, looking for signs of strength in a bull market and signs of weakness in a bear market. Can you trade these principles in a sideways market? Absolutely you can, yes. But you must define what we call a playing field, and I'm going to talk about that again today. To learn the significance of the range or the spread on any individual bar and how to put it in context with the background. Now I've got a schematic that I'm going to show you in a minute that shows what I mean by the range or spread of the bar. To understand why the background is vital to placing a trade at the right edge. The background means looking not just at 3 or 4 bars as they're unfolding at the right edge of the chart, but putting up 500 bars and looking for clues as to what the smart money are doing at certain price levels. Most traders don't do that. And it's so important. The past price does not move the future price, but price levels seen in the background, when the price reaches those same levels today or tomorrow, whenever the market's open and you're watching it, there will be clues, as I'm going to show you on charts. So don't worry, we've got lots and lots of charts to show you. We're going to learn why you don't just look at one time frame. You should look at more than one. I actually use 4 time frames when I'm trading. And next week, when we go through the trading plan, we will go through the time frames that I trade for each of the markets I trade. And I've got these time frames not just from Tom Williams, but from some very good traders. In fact, one of our customers came second in a trading competition last year. His name's Earl Ehrenler. We also had a guy called Tim Raymond who came first in the Forex World Cup Trading Championship using volume spread analysis. Before we move on, can you just type in for me, what do you trade? Just type in, is it Forex, futures, stocks, commodities? What do you trade? Could you just type that in for me? What do you currently trade? Okay, so several saying E-mini, E-mini, Forex, futures, options and stocks, futures, a lot of futures traders here, one Forex. So what do you trade? Just type it in for me, what do you currently trade? Okay, Forex again, all right, futures, Forex, stocks. Okay, so that's the first time I've seen stocks. Oh, there, as soon as I say it, second person says stocks as well. Stocks for the IRA, okay. Okay, that's not the Irish Republican Army, by the way. my business partner's with me. He's trading stocks for the IRA. No, that is actually the US savings plan, basically. It's the pension. Yeah. Okay, great. So there's quite a mix. So yeah, I just want to formally congratulate both of our customers that came respectively first and second in the recent World Cup Trading Championships, where they trade real money and you can actually watch them trade. Here's Earl's result from last year, and you can see he made 63.1% return on his account. Let me ask you, how many of you here would be happy with a 63% return on your account for next year? How many of you would be happy with that? Yes or no? Just type it in. 63.10% return on your account. Okay, I hope no one types in no, because that is quite a nice return, by the way. Yeah, everyone says yes. Good. Yeah, that's not a bad return. And now I just want to show you this. Earl, who's a customer of ours, met me in 2008. He came to a course just like this, just like you're in now. And then he came to a live course that we attended in, which we did in Las Vegas, I think it was. Yeah, it was Vegas that I met him. And he then read the books. He read Tom Williams' book at the time. He's got the software, and he trades futures. And he trades futures on an end-of-day basis. He doesn't trade them intraday. And he got a 63.10% return. Not bad at all. So let's get to the foundation of volume spread analysis. At its core, volume spread analysis, or VSA as we shall call it, is a methodology based on the original works and teachings of Richard D. Wyckoff. Now, have you all heard of Richard D. Wyckoff? Yeah, Mark, I just saw your comment, absolutely. How many of you have heard of Richard Wyckoff? Just type in yes or no before I move forward. How many of you have heard of Wyckoff? Just type in yes or no. If you haven't, I'll explain. Please type in no if you have not heard of Wyckoff, because it's going to be quite important to this Foundations course. So far, no one said no, so I'm going to assume you all know who Wyckoff is. Well, if you don't, okay, if you're just a bit shy and you don't want to type in, here is a website which has got everything you need to know about Wyckoff. It's a very good site. It's www.richardwyckoff.org. And that's a site there that's going to be active from next week with a chat area, a free chat area for people who want to learn the Wyckoff method. But everything I'm going to teach you today, okay, everything about this foundation of VSA is based on the principles of Wyckoff. Wyckoff, very briefly, was a trader in the early 1900s that realized that the markets were moved by, again, what he called the smart money. Okay, so the smart money is the professional side of the market. Okay, the smart money, the professional side of the market. And who are the smart money, you may ask? Well, the smart money are, as I mentioned earlier, groups or individuals or institutions like, you know, we could call Goldman Sachs the smart money. And the smart money understand how the markets operate. Let me just get rid of this here for a second. Bear with me. I'm just going to get rid of that little annoyance down here. That's it. So the smart money, as we call them, exist, and Wyckoff recognized that. Wyckoff recognized that the smart money were active even in his day. And so he decided to teach, much like I'm doing now, the what he would call the uninformed public, how the markets worked. And he used to teach what we call tape reading, reading the tape. Now in his day, of course, Wyckoff didn't have computers, which is why Tom Williams developed the trade guider system, because he did have the ability to computerize the method that was taught by Wyckoff. In fact, Tom himself studied the Wyckoff method in Chicago, at Park Ridge as it happens. The Wyckoff method is still taught today at the Golden Gate University in San Francisco. So it's a very valid method. But it's at its heart, at its foundation, the Wyckoff method is based on reading volume, or activity, as you're going to learn. So the methodology seeks to establish the cause of price movement on a chart. The cause is simply the imbalance of supply and demand as the market trades, resulting in either strength or weakness in the market being charted. This slide's very important. The cause of price movement. Everyone knows price moves. We all understand that. We know that oil doesn't stay static. It moves up and it moves down. But something causes the price to move on a chart. And the cause is simply there's an imbalance of supply and demand, which there has to be in any market. The market doesn't work like a balanced weighing scale. If you read Tom's first book, Master the Markets or The Undeclared Secrets even, both of those books, he explains that the markets aren't like a balanced weighing scale. A market maker has to make the market, and therefore he may have 10,000 sell orders on his books, while he might only have 2,000 buy orders, but he wants to get rid of those 10,000 sell orders to willing buyers. So he has to mark the price up to do that. And this is why the markets are not as simple as people think. They're a little bit more complex, but once you understand volume and you understand VSA, you lift the fog on the market. You take away this cloud, this veil that seems to make the market confusing for many. But we must understand, for the correct analysis of volume, you need to understand that the recorded volume contains only half the knowledge required for a correct analysis. The other half of the knowledge is found when observing the spread or the range of the price bar and the closing price on that bar. Volume indicates the amount of activity on the price bar, and the spread or the range of the bar shows what the price actually did. And most importantly, we then look at where the price closed. Volume, spread, analysis. Volume, activity. That's all you need. If you've got a pen and paper, hopefully you have, by the way, because you may want to take some notes. You are going to get a copy of this PowerPoint, by the way, so you will get that. You'll get that next week. But volume, spread, analysis. The most important thing to realize is volume is the activity. Now, there are different types of volume. There are two main types, exchange-traded volume, which most of you who trade the E-minis will know. You know hopefully, where your volume, in fact, let me ask you, where does the volume from the E-minis come from? So the E-mini NASDAQ, the E-mini S&P, where's that volume coming from? Does anyone know? Just type in. Where is the volume coming from for the E-mini S&P, the E-mini Dow? Does anyone know? Okay, I'll give you a few minutes just to type in. Does anyone know where the volume comes from? Who is actually reporting the volume? Correct, David. You're absolutely right. Do you know which exchange it is for the E-mini S&P? Anyone know? Well done. Good. Okay, for those of you that didn't know that, the volume for the, let's give you an example, for the E-mini S&P, which is one of the highly traded contracts in the world, it comes from the CME Group, which is the Chicago Mercantile Exchange, CME Group. And they are reporting volume through, it's all electronic, although you do have the floors as well, but they put it all into a data feed. And that data is then provided to relative data providers, like eSignal is one that you might know. Thomson Reuters, Metastock, they're another data provider. I use both of those data providers. And they report volume, they report the closing price, and they report the spread of the bar. They report all this information. It's all available on a chart. And we can see it on a chart. Let's have a quick look. Here is a chart of the British pound. Here is a British pound chart of the futures contract. Okay, let me be clear. The futures contract traded from the CME as well. So this is a CME Group futures contract of the British pound, and this was a signal that happened on Friday yesterday morning. It's one that I traded. I took this trade. Now, what do we all notice about the volume on this bar here? What do you all notice about the volume on this bar compared to the other bars around it? Just type it in. I just want to get you involved. What do you notice about the volume on that bar compared to the other bars around it? Mark says huge. Peter says huge. Sharon says high. Okay. I actually call that huge as well. I would agree with, it is in fact, the software calls it, Sean, you're right. The software says UHIGH, ultra high. Okay, I call these Yao Ming bars. I'll show you why later. But that is a great, great signal. Why? Because the next bar closes higher. So you've got what we call a two-bar shakeout. Now think of the logic here. If that volume here was selling volume, i.e. there were more sellers than buyers, the closing price would close on the low. It wouldn't close up near the middle. Do you all agree with that? If that was all selling volume, if that was all sellers, the closing price wouldn't close in there. It would close somewhere down the bottom. Okay? So here, we've got a shakeout. And then again, we've got confirmation on this bar. Because this bar closes higher than the previous bar. And then we have what we call, we'll learn this later, a test that is successful. And if you go long on these shakeouts, and we have a signal that comes up, an automatic signal that appears without the intervention of human beings, the computer recognizes there is a shakeout in the market. And you can make a lot of money trading these shakeouts, especially on the bigger time frames. They work best on time frames above 15 minutes. You know, this is a 15-minute chart. You do see them on smaller time frames. So shakeouts work best, Sharon, okay, just to repeat this, on slightly larger time frames. I don't really take too much notice of them on a 5-minute chart or a 1-minute chart, although they do still move the market. But you can see here on this 15-minute chart a massive volume spike closing up near the middle of the bar with the next bar higher is how we define what we call a shakeout. And this is known here as a test. There's no signal on here, but I don't need a signal on every bar. I can see that the market here has been marked down artificially, but if that was all selling volume in there, we wouldn't close higher. See, we notice we closed higher than this bar. There's clues in those two bars that something is not what it seems. The market's plummeted. It's been a massive fall because of our friend up here, the upthrust, which we'll talk about. So don't worry, we're going to get to all of this. It comes back down and it's bought back. This happens a lot in the markets. The markets don't always continue to fall. Of course they don't. They go up and down. So we're going to try and profit in a down move and profit in an up move. That's what we do. So if you're short here and you see the market mark down like that with the next bar closing higher, you better get out your short. It's time to start looking long. And in fact, if we look at the time here on Friday, this happened at 7:30 in the morning. And if we go to a smaller time frame, say the 5-minute chart, and you look down here, you'll see there again we have what we call selling climax. It's like a shakeout, very similar signal. This is a 5-minute chart now for exactly the same contract. So for every 15-minute bar, I'm getting 3 bars here on a 5-minute chart. And we see here more what we call stopping volume. We're going to learn all about this in this course. You're going to learn what these mean. And of course the market rallied. We had a pretty decent spike up. Now, be warned, I expect on Sunday night, tomorrow, when the market's open, this market to come back down to this level. So I'm looking for shorts now on this chart, not long trades, because I think the market's going to come and break this low here. And we'll talk about that at the end. So volume, spread analysis. Volume is activity. You might want to write that down. Volume is activity. The spread, or the range of the bar, which I'm showing you here, is what the price actually did on that volume. Now we can have 3 types of spreads. We can have narrow, we can have wide, we can have average. Okay, now in this example, we're showing a wide spread or a wide range. Okay, so let me just repeat this. The spread is the high and the low of the price bar. Now, question comes in, what time frame? It doesn't matter, as I'm going to show you. This methodology works on a 1-minute chart and it works on a monthly chart, and I'll prove it to you. Now, most people think, even Tom Williams, when he was inventing this, sat down with a computer programmer, and when Tom said, well, I think it'll work on a 1-minute chart as well as a daily chart, the programmer laughed at him and said, that's impossible. No way. It can't work like that. But it did, because the markets are moved by the imbalances of supply and demand in every time frame. It doesn't matter if you're even dealing with a 10-tick chart. There will be imbalances of supply and demand at all times. So it does work in multiple time frames, as I'm going to teach you. So volume is the activity on the bar. The spread is what the price has done during that time frame. Let's imagine, for the purposes of this particular schematic, that this is a daily chart, shall we? Or just, I'm not very good at writing with this pen, but let's imagine it's daily. So there's your volume, which is the activity. Okay, so it's activity. There's the activity. There's the spread of the bar. That's what the price did during that day, because we're imagining this is a daily chart, okay? So during the day, the price went up and it went down, and it formed a price spread. We call that a wide spread. But then most importantly is this little tick there, the closing price. Now, I'm sure in your mind you're thinking, why don't they use the open? Because nothing's happened. When the price opens, when the market opens, I don't see the result of the effort. What I mean by that, Tom explained it to me quite nicely. He said, Gavin, you employ a lot of staff at Trade Guider, and you want to know if they're working hard for you. Do you make that judgment at 9 o'clock in the morning when they get into the office? Or do you make that judgment at 5:30 when they leave? And I said, well, Tom, that's a silly question. Obviously, at 9 o'clock in the morning, they haven't done anything. So how the hell can I make a judgment about how effective they are? But at 5:30, I can see they've made 150 phone calls, they've helped 50 customers, I can see they've worked hard. He said, exactly. It works the same on a price chart. When the market opens, you don't know what the professional money have done because they haven't done anything yet. But my goodness, when the market closes and the price bar closes, you can see what they've done. So if this is a 1 minute chart, you will find bars forming every minute. And then we're looking for unusually high volume followed by unusually low volume. Always remember, wherever there's high volume, it means some institutional group or the smart money have become very active. And if they've become very active, that means the market's about to move. Then, if the price level in the future could be within 5 or 6 bars, could be longer, goes back to the same level, as I'm going to show you, so don't worry, I've got a chart to show you this, and it goes there on low volume, we know that they're no longer active for a reason, because they may have sold in the background. In this instance, we can see that this high volume must have been selling volume. And how do we know that? Because the market in the future fell. But it doesn't fall instantly, and that's the bit that confused me initially about VSA. We see a sign of weakness appear, and the market appears to continue to go up. And the reason for that is what we call momentum. Price has momentum. It's like I use the analogy of a car, an automobile, driving up a hill. Now imagine you're driving up a steep hill and you put your foot on the gas pedal to get up the hill. Now what happens, everybody, when you take your foot off the gas pedal? Does the car just stop instantly, or does it continue to roll a little bit further, albeit slowing down as it goes up? Of course it does. As the car goes up the hill, you take your foot off the gas, try it for yourself, it will not just stop unless you put the brakes on. And price action does exactly the same thing. It moves, it moves, it moves, then a bout of selling comes in from the professional money, price may still drift up, but what happens is in the volume gets lower and lower and lower as they reduce their interest. And we call that, when the volume is very low on an up bar, no demand, especially when the spread is narrow and the price closes on the high or middle or low. It doesn't really matter. The key is the low volume. And if you imagine, if a price is going up and the volume is going down, that means some groups are not interested in higher prices. I refer to these groups now as the smart money. And that means there's going to be an opportunity to potentially short the market. So let's get rid of the drawings. So is there any questions on that schematic? Any questions at all? I'll check. Anything you're not sure of so far? I'll wait a few minutes here to get so you've got time to type in. Is everyone clear? Let me just ask you this. Is everyone clear? Type in yes or no. Is everyone clear what volume spread analysis is so far based on that schematic? Does everyone understand what I've just showed you? Good. Excellent. I'm more than, as long as you understand that, I'm more than happy. I don't want anyone to be left behind. If you've got a question, type it in. Type it in. Because my job is to ensure that when you leave here today, you have a really good base understanding of what VSA is. Okay, so we understand VSA is following volume, which is at the bottom of the chart, which is activity, the range of the bar, and the closing price. Now, does it just look at one bar? No. The clever thing about the VSA indicators is they look at relative volume compared to the previous bars. They actually go back, I don't talk about this publicly, but I can here in this course, they go back about 15 bars. And they're looking at relative volume to the previous bars. What do I mean by relative volume? Well, it's quite easy. In this example in the British pound, I can see that that volume there, relative to the other bars, is extremely high. And the market went up. But notice, we have a wide spread down. So the market's marked down here artificially and then marked back up. here's the same example. Widespread down. The next bar here, we have more volume coming in, but notice the range of the bar gets narrower. That's a key clue. We call that narrowing of the thrust. Okay, the narrowing of the thrust down. That's a very good indicator that professional money are stepping in to buy the market. You'll notice that TradeGuider has green and red signals. Now, for those of you that have the software, these do not mean buy on every green signal, sell on every red signal. That's not what the software is designed for. We have to look a little bit closer at the chart to determine when the best time to buy is. Now, when we see the market do this, I'm going to teach you in this course certain situations that appear on the chart which give you a higher probability trade. And when I see in 3 or 4 time frames the market being artificially marked down or artificially marked up, I know there's a trap being laid for the uninformed public who are going to go short or long. In this instance, as price falls, a lot of technical indicators down here will be firing off sell signals because they'll be based on a MACD, a stochastic, a moving average. And yet, if you'd have gone short down there, you'd have lost money on Friday. So it's very important when we look at volume to look at it in context with the background, as we're going to show you, and then look at what the market does afterwards in the next 4 or 5 bars. So, in summary, volume spread analysis is analyzing the activity of the smart money. The spread of the bar tells us the effort of what they're trying to do on the price. The closing price tells us the result of that effort. And here's the man that invented volume spread analysis. His name is Tom George Williams. You should all know who he is. He was born on February the 4th, 1929. He says, if you can read a chart correctly, you will understand the markets do not move randomly, but are moved by the smart money. And you can see their intention at support and resistance levels by looking for the telltale footprints hidden in the volume and price. You have a chance to profit by following their footsteps. Volume is vital in your analysis, which is why the self-regulated exchanges around the world will not release the true daily volume figures, I should put there, until the day after trading took place. Tom himself was a former insider, if you like, a syndicate trader who recognized that there was a key missing ingredient for the retail public, and that was volume. Now let's have a look at some basic concepts, just basic. I'm not going to get too advanced here. I'm going to show you a chart now of the S&P cash market. Now I'm going to show you a couple of things here that are important to recognize on any chart. So whilst this is a daily chart of the S&P, I want you to notice a couple of things here. Now look at the chart. Do you all notice the ultra high volume on that chart? Can you all see it? Yes or no? Can you all see the ultra high volume that I've marked on that chart? Everybody see that? Okay, good. All right. Now, can anyone tell me on that day, on that volume, what the news was? Anyone remember? It was last year, and it was in August. Give you a clue. What was the news on that day? Anyone got any ideas? I know a lot of people sometimes find it difficult to go back a year and remember what happened, but it was almost a year and a bit ago, a year and 2 months. August of 2011. Well done, Mark. You've got it. What was happening here? Can you go back and think? Only one person's got this right. Everyone else doesn't seem to know. What happened in August, first week of August last year, which was a signal apparently to get out of stocks? It was a major drop in the market over 2 days. I'll give you a clue. What happened to the US government? I'll give you another clue. Moody's. Well done, Peter. You've got it right. I'll give you another clue. S&P. What happened? Come on. There's only 2 of you who've typed in. Then you must remember this. It's really important. What happened on that day? Well, looks like a lot of you just don't remember it. It is, David. Well done. The US government was downgraded. That's right, Sharon. Well done. There was a downgrade. Now, here was what I've actually got somewhere, the recording of CNN. I recorded it on my video. And they went to the exchange floor on this day here, right there, where you see the widespread down in this very high volume. And they said, everyone is selling. Everyone is selling today. The fact that the US has downgraded means like stocks like Apple and Google and Microsoft are going to collapse. Everyone is buying. They're buying gold. Everyone's buying gold. It's a safe haven, everybody. Everyone's got to go and buy gold. Get the hell out the stock market. And do you know something? A lot of people did. In fact, the majority of the general public here was shaken out of the market. However, what do we notice about the day after at this price level here, right at 1100? Look at what happens here. We've got to look at the price bars. We have a widespread down with massive volume. But the very next day, the market closes up into the 50% level of the bar behind it. Now, only one thing can cause that. There must have been a lot of sellers in this bar, but there must also have been buyers there. We refer to sellers as supply. We refer to buyers as demand. Please write that down. That's important. Sellers is supply. Buyers is demand. Sellers is supply. Buyers is demand. In this bar and this bar here, there is a massive interaction going on between buyers and sellers, or supply and demand. What's actually happening here is this is what we call the start of accumulation. Okay, the start of what we call accumulation. Now, there are two things you should write down now which are important. Number one, professionals accumulate at lower prices. Okay, so smart money accumulate as markets fall. Point two, professionals or smart money distribute or sell as prices rise. That's a very important statement. And once you understand, you'll start to think like a smart money trader yourself. So accumulation happens as the market falls, usually when some sort of panic is set in. Because just like a herd of cattle or a herd of sheep, when they see the sheepdog approaching them, they tend to all panic and move in one direction. Well, unfortunately, human beings, believe it or not, act in herd behavior. We do. And in the markets, it's very obvious to very clever people that when the herd panic, there's an opportunity to make money. In this instance, the news is extremely bad, very bad. However, would you rush in and buy at that low? No, I wouldn't. Some people do. Some of our customers do. I wouldn't. And I'll explain why in a minute. When we see massive volume like that on a down bar, I know that the market is unlikely necessarily to go straight up. If professionals accumulate, they do so over a period of time. Now notice how long it took to change this bear run into a bull run. Let's actually go and look at the actual chart on a weekly chart. Right. This is the weekly chart now of the same chart I just showed you. Let me ask you all a question. Are we in a bull market or a bear market? Are we in a bull market or a bear market? Just type in your opinion. Are we in a bull market or a bear market right now? Okay, just keep typing, please. Everyone, please contribute. I need to get your thoughts on this, and there's a reason I'm asking everyone to type in. Are we in a bull market or a bear market? Okay. Okay, good, good. I've got a lot of people typing now. Every single person has said this must be a bull market. But now, the news on television and on the newspapers is, this is actually a chart going all the way back, Sharon, to March of 09. I can go even bigger. I'll show you in a minute why I can do that. But I just want to start. This is since 09, we've been in the third biggest bull market this century. But everyone is in fear. The general public have missed out on a lot of this move. And the reason is, every time you switch your TV on, every time you switch on, even on the internet, even on financial channels, everyone's in fear. The fiscal cliff, the massive debt problem, the this, the that, the that, and it goes on. And if it's not Greece 1 week, it'll be the European crisis, then it'll be something. But lo and behold, there's only one reason we're in a bull market right now. It's because professional money bought at lower prices. And where did they buy? Right here. This is the weekly chart of August in the downgrade. Look at the volume on that bar. It's enormous. And we notice, and this is an important principle, that as the market goes up, it retraced here into the level of that bar. But now look at the volume here as the market retraced. As the market pulled back, the volume got so light on the weekly chart because professional money had already bought just there. So as the market retraced on some news, there was some negative news there, look at what happens to the volume. The activity gets much lower as the price falls. This is a very serious sign of strength in the market. And it's the reason that this market has gone up. Now, only a few weeks ago, in the VSA Club, I forecast that the market would hit 1400 in the next 2 weeks. And it did. And the reason it did is because of this bar here, right there. We notice that it's hit this little dotted trend line. Now, I'm going to show you how to draw a trend line right now on this chart. I'm going to show you how I selected these points. Let's do that now. So let's put up 400 bars. I think that's as far as I can go on the data, actually. There we go. Can we go any further back? No. Okay. So I can tell you that that is the bottom. That's the low of 2009. It's the 6th of March low. Now, since that point, we've made a secondary low here, as we can see. So in order to draw my trend channel, and let's just do it for you, I'll just delete this one, and I'll start again. What I'm going to do is I'm going to take my first 2 lows and the first high, which is going to be around here. So join those 2 together, and the computer will select for me automatically the intersecting high. So click this button, take our first low here, connect it to the second low and let go. Now, Trade Guider has selected that high, which is perfect. There's nothing wrong with that, but that is also a high in between these 2 points. So I can manually adjust this by just clicking on this level here. And I can just click back and go back to that intersecting high in the middle there and see if the channel looks better. Now, I can also say this, and there it is, look. Notice here that the price bounces off the channel once here and twice here. So that is a better channel. Now, if you want to learn how to draw trend channels, it is an art, it is not a science. There is a great book I'm going to recommend to you. It's only $10, and it's called Sticky Stock Charts. And it's how I learned to trade these, or to draw these channels. And it's by Lawrence Holt. I'll type it into the chat window. There you go. Sticky. Can you all see that? Sticky Stock Charts by Lawrence Holt. Can everyone see that? I just typed it into the chat window. Okay, good. Now, I click on OK here, and I'm going to put on what says the center lines is and the quarter lines. Now, these are important lines, as I'm going to show you, and this works much better on bigger time frames. There we have a very good, solid, weekly trend channel. Now, we notice a few observations on this chart. Number one, the market, when it gets to the top of the trend channel, becomes weak. Okay? What I mean by that is, look, we have an increase in volume on the first bar, but the next bar closes lower. We call that a top reversal. Now, markets at the top of trend channels get weak, especially in uptrends, meaning that profit taking happens. That's what we're seeing up there, profit taking. Then, as the market falls to lower prices, the stocks become more attractive. Now, remember, this is the S&P 500 index I'm looking at. So it represents 500 US stocks. And we know those stocks are made up of some of the biggest companies in the world. So the professional money know that they want to buy those stocks at lower prices, wouldn't you? You don't want to buy high. So you take any opportunity you can to buy at lower prices. The market falls. The news is bad. Here is the downgrade again, 12th of August. News is negative, but on that widespread down bar, and what do I mean by a down bar, by the way? Let me just clarify that. A down bar is a price, please write this down. A down bar is a price bar that closes lower than the bar behind it. I'll repeat. A down bar is a price bar that closes lower than the bar behind it. An up bar, however, is a price bar, like this one here, that closes higher than the bar behind it. That's how we define up bars and down bars. Okay? So I'll repeat that again. A down bar is a price bar that closes lower than the bar behind it. An up bar is a price bar that closes higher than the bar behind it. And that's how we define it. And so in this instance here, we have a down bar. A down bar that's closed lower than this widespread down bar. This and this was all caused by negative news, I can assure you. However, the market stops here on that high volume, the highest volume we've seen, and it stops at a level that I call a trigger number. Now, what do I mean by that? Look to the left. Where's the next or equal highest volume bar to there? It's there, isn't it? Back here in March of 2010. And this area here was the closing price on that bar. Now, look how significant that price level there became over here. The market never closed below it, which would tell me that on this bar here, where the high volume is, there must be a lot of buyers holding on here, and they don't want lower prices. We also observe on this weekly bar that the price closes up near the top. Now, if that was mostly sellers there, I'd have expected it to close in the middle or the low. So we know there that there must be something going on. That bar there is what I call a Yao Ming bar. That bar there is what I call a Yao Ming bar, and I'll come to that in a minute. The market then goes choppy for about 2 or 3 months, and then it begins its breakout phase. It breaks out in December, and look here. As the market retraces at the end of December, we get very, very low volume, and on that bar there, you can't see it, but there's a very low volume bar at the end of the year, and that is the precursor to this rally. And we are still in a rally. I expect us to make another high at some point in the next few months, because we can see a couple of weeks ago, look at the volume, pretty high. But look at the spread of the bar. It's getting narrower as it fell onto my dotted line, which is now acting as support. Peter's asking a good question. Is the trigger number always the closing price? Great question, Peter. And the answer is no. It can be the top of the bar, the closing price, or the bottom. All three are relevant. Very often, I haven't done it on this chart, I will project those out. Let me show you what I mean. It's a good question. So here's the bar that I've looked at because it's got the highest volume in the background, which we can all see. Now let's mark the bottom of that bar as well. And we'll put OK. And let's mark that with a limey coloured bar there. Make it heavy. So there's the bottom. OK. So that's the low of the bar. And now let's mark the high of this bar as well. And let's see if those price levels became relevant in the future. Oops. Let me delete that one. All right. So now look at this, Peter. This is very, very important. I've marked the top, the close, and the low of the bar. The low of the bar is determined at 1065. Okay, just here. The closing price is at 1111. The high is at 1206. Now watch this. Let me delete that first green one. Taken off that one. Okay, let me just delete the other one. Okay, and let me just re-add this one, which is the closing price. And we'll put that in green again. Right. Now look at this. This is what I call looking at the background of the chart. The background was very relevant even 2 weeks ago, because down here at the bottom of this trend line, and I think TradeGuider is the only software that actually plots these dotted lines for you, and they are extremely powerful. Now I call this trend channel the playing field, because I used to play soccer at a pretty good standard, and in soccer, as in American football, you have an area that's defined as a pitch. Okay, so you have white lines that define where the ball is in play and when the ball is out of play. So in a soccer pitch, we've got two goals, one at each end. Same with American football. You have two goals, and the objective of the team is to get to the goal. I always imagine that the price action is the ball, and then you've got the Bulls and the Bears who are playing on this playing field. When the Bears are in control, we get down and the market begins to fall. When the Bulls come back, we push back up. But all the time, we're trying to get to our goals. Now, the goal was scored here by the professional money. They bought the market down here and here. But they bought it at a level in the background that was relevant. 1112. Can you all see that? Just type in yes. Can you all see what I'm showing you here? Look at how the market came down and touched that 1112 close, but it never ever got closed below it. Can you all see that? Just type in yes or no. Can you all see what I'm showing you? How the background here in 2010 became relevant in 2011. Can you see that? And you've got to know this information, because when price comes down to that level in the future, as it did here, and it refuses to close below it, it's a great place to put a stop, because they clearly, when the market rallies, don't want to take the market any lower than around 1112. So let's project out into the future. We now look at the top of the bar. The market goes through it here, and look at what happens here. We have a very low volume week right there. Okay, on that weekly bar. And the very next, we break out above the close. That's what we call a test in a rising market. Now, if we put on the TradeGuider signals, we will have a signal on this weekly chart. I guarantee it. Let's switch on the TradeGuider signals. So here are the signals. We've got two of them at this price level at the top. But the most important one is the one here. It's called a test. And what a test is very simple. It's showing us that as the market has attempted to fall, the range of the bar is very narrow and the volume is extremely low now. Now, why is that? Because professionals are not selling the falling price. It's the smart money make up about 90%, maybe even 95% of the traded volume in these markets. And so that level became very important. Then we get to the top of the trend channel, here and here, and we start to see no demand. It means they're not ready to push this price up yet. They're going to mark it back down for more buying. And of course, we now know that's exactly what happened. Again here, what do we see? Last year, no supply test. And these are very strong signals because the market is rising, not falling. Now, we had a signal 3 weeks ago, and it was the one I warned everybody about in the VSA club. We've had the shakeout here. Now they've tested it, and we've had higher prices. The signal on these weekly bars is a really good clue as to what the market's going to do. If you see a VSA principle on the weekly chart, then the market will very often respond positively. And therefore, we have now seen here the market go up for the last 2 weeks. In fact, it broke 1400, as we know. It closed last week at 1416, as we can see. So we know, therefore, that this market is in a bull phase. There's absolutely no doubt about it. Okay, it's in a bull run. And it's because of this. Now, I'm not going to be particularly bearish until I see equal volume on the upside coming in with that sort of volume and a narrow spread like that. That's when I start to become very negatively charged on this market. But of course, when that happens, the news will be so good, everybody will be saying, hey, this market's going to it's going up to 1800. The news will be good at that level. But that's when you should sell it. But at the moment, the news has been bad and professionals have been buying. So remember, smart money buy on bad news and they sell on good news. So let's talk about the 2 key rules of the foundation of volume spread analysis. 2 key rules. Rule number 1. When weakness or opportunities to go short appears on your chart, they will appear on an up bar. That is a price bar that has closed higher than the bar behind it and will be an unusually high volume, we call it ultra high, or unusually low volume. Now, think about that. That statement there sounds as though I'm contradicting myself, but I assure you I'm not. And it was the one thing about volume spread analysis that initially confused me. Because Tom said, well, yes, you have very high volume at this price level, and now you have low volume as the price goes back up to that level. Both are important, and both are part of a trade setup. How many of you have read my second book, The Volume Spread Analysis Trade Sequences Explained? How many of you have read my second book? Just type in yes or no, because if you haven't, I'll send you a copy free with my compliments, because it'll help you with this. Okay, I'm going to send you a copy of that book afterwards, free of charge, okay? So you can read about these sequences. So I'll send you that with my compliments. You'll get it in an email, hopefully sometime over the weekend. Now, it explains, okay, Sean, that's fine. I'll send you the book, because that's the best way to learn, in my opinion, is read the books. There's my first book, and there's also Tom's book, Master the Markets. That's really important. But my second book is going to explain why weakness appears on ultra-high volume and then again on low volume. So here are what defines the key VSA signs of weakness. They're usually, 90% of the time, the weakness will appear on an up bar, which I've already mentioned is the close is higher than the bar behind it. However, there are some signals where weakness appears on down bars, but I'll show you those next week. The spread can be narrow or wide, doesn't matter. The close can be in the high, the middle, or the low. That doesn't matter. The volume can be high or low. A narrow spread on the bar indicates supply overcoming demand. The supply, or sellers, cap any attempt to move the market up. Ultra high volume up bars, the classic trap of the smart money. Professionals have no interest in the upside, you get low volume. Professionals are selling into the rush of buying from the public, higher volume. High plus volume shows supply, public buying, smart money selling. Low volume shows no interest from the smart money, so prices will not go higher. Let's have a look. Now you're going to get a copy of that slide next week, so you've got to, that's a very important slide. But let's look at an example. This is a classic VSA trade setup. Classic. First of all, this is on Caterpillar. There was a news announcement. This was in April of 2010. Great earnings report came out. We notice here a massive gap up in the market. The market's been in a bull run for some time, so it's been going up and up and up. The news comes out, and it's a very good news story. Buy Caterpillar. Everyone's buying Caterpillar today. You look at the news, you switch on CNN, everyone will be telling you, buy Caterpillar. You may even get a broker on the phone. Did you see what happened to Caterpillar today? It gapped up at the open. The news was good. Look at the news report. They've had their best earnings for the last 4 years. But you as a VSA expert will look at that volume and you'll look at the range of the bar. Now the range of the bar, or the spread, is very narrow. But the most important part about that bar is the closing price. Can anyone tell me why? Anyone got any ideas why the close is the key to that price bar, and why it's telling me that supply has to be overcoming demand? Have a look at the bar. What do you observe? Just type it in. Anything. What do you observe about that bar? We know it's a narrow spread, and we know it's on massive volume. I call that Yao Ming. But what do you observe about the close? Well done, Mark. Well done, Wilson. Well done, David. Well done, Peter. All perfect. Yeah, well observed. The most important thing, it's closing in the middle. It doesn't close on the high. It doesn't close on the low. It's closing right slap bang in the middle of the bar. Now, on that rushing in, after seeing higher prices, and it comes out, the price has gapped, they now fear missing out on what they're being told is going to be higher prices. On that day, I remember it because I traded it. I put option on this and made quite a lot of money. On that day, I remember one news announcer on CNN, no, sorry, it was CNBC, said he was forecasting Caterpillar to go to 150. That's what was being said, because they were in such a strong position. However, I sort of looked at it and went, that looks very much to me like what we call a buying climax, or the end of a rising market. Both are powerful signals. And they're in the software, so the software will give you a signal. In this instance, it did. It told me it was a buying climax. But I observed the next day was the clue. Because what do you now see? What happens the next day? Everyone's long, the price collapses. We come down, not up. Now that, if you've got a put option here, which means you're short, you're betting the market's going to go down, you see the next bar down after that high volume and the narrow spread, you know you're right. You know you're right. You know they're selling in that bar. There must be supply overcoming demand, or that bar wouldn't close lower. But then look what happens. This freaks most people. They say, well, hold on a minute. If that's all sellers there, what the hell's going on up here? The market's gone back up for a couple of days. But look at the volume. The market maker is keeping the price at that level to encourage any buyers to still come in and buy, so the market maker can sell to them, because he's got a hell of a lot of sell orders to get rid of. Sure enough, the market then next day collapses. Okay, and then again, we go up. The market maker holds the price up, but look at the volume again. Very, very low. So now we can see why at these levels, ultra high volume followed by, excuse me, very low volume, it's a setup. This is called a buying climax followed by no demand. And that is a great, great, great short. And you see that a lot on the S&P. You see it a lot on the E-minis, the currencies. You see it on 5-minute charts. And when we all trade live together a week Monday, we'll look for this. Is there any questions on that chart? Any questions? I'll give it a couple of minutes here. We're going to take a break here in about 10 minutes. Someone said we're going to break. Yeah, we'll break in about 10 minutes, and we'll break for about half an hour. We'll have a half-hour break. Yeah. Yeah, I know it's a lot of information. Good. I'm glad you're enjoying it. Good. Good. So there you have a climactic bar. I went short there. That's where I went short, on that bar. I was there then convinced. That's when I brought my put option. Because I didn't go short here, even though Tom Williams would. And I didn't go short there, okay, because I was still waiting for the market to change trend. But as soon as that bar collapsed and took out the support here, and then it went back up on no demand, I thought there's no way that's going to go higher. And as it happened, it immediately fell. And again, every time it tried to go up, it went up on low volume, so I knew I was right. And I held on to that option for 3.5 weeks. And I do trade options, yes. I'll tell you what I trade. I trade intraday. I trade the currencies mainly. I trade the E-mini S&P, and I trade the NASDAQ. They're my specialist markets. I now trade gold and silver as well. I also trade options on stocks. I love trading the options on the. I've got a portfolio of about 15 stocks now that I follow in the US. They're US stocks, although I am going to be starting to trade the UK stocks as well. But is there any questions on this? Can you all see what I'm explaining here? The gap up, the news is good. It produces a sign of weakness. It's on an up bar, closes in the middle, next bar down, and then we go up on low volume. Do you just type in yes or no? Do you all understand that principle that I've showed you there? And it's usually going to be on good news. That's why you'll miss the trade. Most people miss these trades because the news here is so good and bullish. A bit like gold last year. Look at what happened to gold. Good. All right. Everyone gets that. All right. Well, then let's finish this session before we break with signs of strength. So, number 2 then. When strength or opportunities to go long appears on a chart, that will happen on a down bar. That is a price bar that has closed lower than the bar behind it and will be an unusually high volume or, just like in the previous example, unusually low volume. So this is what defines signs of strength. They're down bars, most often. Narrow spreads can be on wide spreads though, but they can close the middle or the low. If they close on the high, which is rare, that's even better, like we saw in that example of the S&P. But usually they'll close in the middle or the low. Volume can be high or low. The narrow spread, now that's a key thing to look for. If you've got very high volume and a narrow spread bar, that's going to make you money because it's telling us something. Buying on a down move will prevent lower prices. Ultra high volume down bars, again, when they're ultra high, when the volume is massive, that's telling us something. Professionals have no interest in the downside, we get low volume on the down bars. If professionals are buying into public panic selling, then you get higher volume, like we saw with BP. High or ultra high volume shows demand. Public selling, smart money are buying. Low volume shows no interest to the downside from the smart money, so prices will not go lower. This is a classic example again. What do we notice about this? This is Citigroup. This was the day, I think it was when, just after Lehman Brothers had gone bust, and all the banks were going to be bailed out. I remember this well. And all of a sudden, we saw a signal called bag holding. Okay, it's also known as a selling climax as well. This is where the news is awful. I mean bad. You're going to switch on your television. They're going to be looking at you going, Citigroup are going out of business. Government are bailing them out. Citigroup are going to be, they're going to lose billions of dollars. This is what you're going to hear. And you're going to think, there's no way I'm going to buy that. No. Now I'll look for something else because the news is so bad, but don't ignore the news. What does the chart tell you? Now, what do you all observe about the volume on this bar? Look at it. What do you notice? Type it in. What do you notice about the volume compared to the previous bars on that bar? Just type in. What do you notice? What do you notice about that volume? Is it enormous? Is it, yeah, Wilson's already said Yao Ming. I haven't even got to that slide yet, Wilson, but that's very good. It's massive. It's a skyscraper. It's enormous. It's even gapped down, look. The stock gapped on such terrible news. But look at the range and look at where the closing price is now. Right in the middle. And the next bar closes higher, telling us that the buyers are there. As the market retraces, there's no pressure on the downside. And that stock went up massively. Big rally after that. And that's because professional money buy on down bars. And they make sure that the news is so bad, you don't want to be involved. Now, in this instance, I didn't get long on this, okay, until several bars up here, because I waited for a change in trend. And I often do that. But Tom will often, because he's got a lot more money than I've got, will often see that signal and just buy and put a stop just a few ticks below the bottom of the bar. And very rarely, when you see that signal, does the stock ever go down any lower. And it's a very good place to put a stop. And even if you start off trading a small amount on those signals and what we call pyramiding in, that would be okay. Peter says, if that bar closed on the low, would we expect lower price? It's a great question. Depends on the next bar, Peter. We're always looking at the next bar. If it closed on the low, and the next bar then closed up level with the top of the bar, that would be known as a two-bar reversal. That would be strong. If the next bar, if it closed on the low, and the next bar, so it closed on the low, and the next bar we close lower on the next day, I wouldn't touch it. I wouldn't even get involved, which is why I always wait until the next bar is closed for confirmation. And here, I wouldn't necessarily buy there or there, because my diamonds are telling me that the market's still trending down. But what gives me a really good clue that the market's about to rally is as the price comes down here, every time it falls, there's very low volume and the spreads are narrow. And that tells me there must be buyers in there. And then here, when these bars turn blue, I look for the first test anywhere at that level, and then I go long. And that's actually what I did do. I think I was long about $3.80 on this. So I actually wait, personally, I have to wait, I'm very patient, for a change in behavior after that signal. A change in behavior in the market. I'm just looking for a change in trend. Simple as that. I'm looking for a change in trend. Okay, good. All right, let's break. We'll take a 30-minute break until 5:02. Let's come back here, right there. Let's come back in here at 8 o'clock US time there. And we're then going to go and show you a couple of actual real-world examples of market manipulation in action. And I'm going to show you a trade setup for next week in gold. For those of you that trade gold, I know some of you don't, but we'll look at that. And also we'll look at the S&P as well. I hope you're enjoying it, everybody, and I'll be back with you here. I'll put the clock up there at exactly 8 a.m. Chicago time. See you all in about 31 minutes time. Have a nice break, have a cup of tea, a cup of coffee, and we'll get on with part 2. Running in towards 10 o'clock. Hope you're all enjoying it. Be back in about half an hour. Okay, welcome back everybody to part 2 of the Trade Glider Foundations course with Gavin Holmes, and delighted to be with you all. And we're going to sit and talk now about something that's quite important. Let me ask you all a question, and again, just type in yes or no, you'll remain anonymous. Do you think that the financial markets are being manipulated or can be manipulated? Yes or no? What do you think? Do you think the financial markets are or can be manipulated? Yes or no? Joe, the financial markets, I'm talking about the main markets around the world, the gold market, silver, S&P. Okay, well let me Joe, probably for you, let me give you an example of what I'm talking about, okay, because I think this is quite important. Okay, define manipulation. Brilliant, that's a great question. A manipulation is where the question that every buyer there is a seller. Now, that would sound at face value to be an obvious statement. However, the way the markets work isn't quite as straightforward as that. Because what happens is you have a market maker who may well have a large number of orders on his book that he needs to get rid of or she needs to get rid of. And certainly if a particular entity or entities have large concentrated positions in a market, they can influence the market, they can control the market. And this next section, Joe, is going to be a great example of that. And this is the only part of this course that I might say is a little contrarian, but it's a fact. And remember, I'm an ex-policeman, so I want you to imagine that I'm just giving evidence. Simple as that. Everything I'm going to show you here is available on the internet. Joe says, isn't that how the business is done? Yes, it is, Joe. And what I want to teach you, though, is the markets have been manipulated for hundreds of years. That's exactly how the business works. Is it illegal? Yes, it is. But that's how it works. And what I want to teach you is how you can make money yourself, legally and ethically, by following the footprints of when the manipulation is happening. Because it takes millions and millions of dollars to move a manipulate market. Good. No problem, Joe. Well, that's what I want to teach you. I'm not interested, by the way, I'm not a conspiracy theorist. I don't care that the markets are being manipulated. But I've actually, this next story that I'm going to show you demonstrates that not only does it happen, but I'm going to show you how volume spread analysis picks it up clearly. And that means you can see, as it's happening, what these groups are doing, so you can profit from their moves. So let's have a look at an example. Well, look at gold and silver, because there's a guy, I don't know if any of you have heard of him, Andrew Maguire. If you type his name into Google, you will find details of what I'm about to talk about. Okay, you will actually find that. His name is Andrew Maguire, and he was formerly a Goldman Sachs bullion trader. And this is the only printed article on this story that happened in 2010. The mainstream media would not report it. The main newspapers would not report it, but the New York Post actually ran the story. And this is an actual clipping from the New York Post in April of 2010. And it says, metals are in the pits. Trader blows whistle on gold and silver price manipulation. Okay, the price of gold and silver have been allegedly suppressed by JP Morgan Chase and HSBC. So they've named here the actual institutional money that's actually suppressing the price. According to a London whistleblower, Andrew Maguire, who laid out the bank's plan in emails to the CFTC prior to trading on the COMEX on the 5th of February of 2010. Now, I've actually got a copy of the emails that were sent to the CFTC in America advising them of a manipulative event that was about to happen before it happened. This is the actual email, and it comes from Andrew Maguire to Elliot Ramirez and Bart Chilton of the CFTC. And the reason this is important to this course is it's important to understand that you can spot the manipulation and then trade in harmony with it. So he says, dear Mr. Ramirez, thanks for your response. I thought it may be helpful to your investigation if I gave you the heads up for a manipulative event signaled for Friday, the 5th of February. Now remember that date, it's important, 2010. The non-farm payrolls number will be announced at 8:30 Eastern Time. There will be one of two scenarios occurring, and both will result in silver and gold being taken down with a wave of short selling designed to take out obvious support levels and trip stops below. While I will no doubt be able to profit from this upcoming trade, it's an example of just how easy it is to manipulate a market if a concentrated position is allowed by a very small group of traders. I sent you a slide of a couple of past examples of just how this will play out. Scenario 1. The news is bad, employment's worse. This will have a bullish effect on gold and silver and the US dollar as the US dollar weakens and the precious metals draw bids, spiking them higher. This will be sold into within a very short time, 1 to 5 minutes, with thousands of new short contracts being added, overcoming any new bids and spiking the precious metals down hard. Scenario 2, the news is good, employment's better than expected. This will result in a massive short position being instigated almost immediately with no move up. This will not initially be liquidation of long positions, but will result in stops being triggered, again, this is important, targeting key support levels. Both scenarios will spell an attempt by the two main short holders to illegally drive the market down and reap very large profits. Locals, such as myself, will be invited on board, which will further add to the downward pressure. The question I would expect you to ask is, who is behind the sudden selling, and is this entity or entities holding a concentrated position? How is it possible for me to know what will occur days before it will happen? Only if a market is manipulated could this occur. This was sent on February the 3rd, 2 days before this happened. Interestingly enough, during this time, CNBC actually came out with a headline. Everyday investors wonder if the market is rigged. Joe says, wow, they strategize this ahead of time and coordinate a time and event, then trigger the manipulation. Yes, Joe, exactly what happens. Exactly. You won't hear many educators teaching you this because it's contrarian, but it's a fact. And it's starting to be more and more generally accepted by traders around the world that this goes on. Now, there's a website that's got a lot more information on it than I'm going to give you here. And it's actually, I think, got the interview with Maguire on it. I'll type it in here. It's just www.marketmanipulation.com. That's one of our sites. But what we're interested in is this has been going on for literally since the markets began. It's an opportunity to make money. Human beings want to make money. Of course we want to make money. In fact, Richard Ney, I don't know if any of you have heard of this guy, but he was an actor who turned an investor. And he was born in 1915 and he passed away in 2004. Great books. I've got 2 books by Ney. I've got 3. 2 of them are signed. You may have heard of these books, The Wall Street Jungle and The Wall Street Gang. He's got some great comments in these books, some really funny ones. He said, which it is shown that if you scrap traditional approaches to the market, and he uses the word, and attack the financial conspiracy with its own weapons, you can beat the stock exchange insiders at their own game. What he means is if you understand the game, you can make a lot of money. And you don't have to do anything illegal. That's the wonderful part about this, because all we're doing is reading the information in the chart. Joe, you might like this. Have a look at this Rolls Royce. Can you all see the number plate? I think that's absolutely wonderful. That's the number plate of Richard Ney's Rolls Royce. Correct, Joe. You're absolutely right. Of course, you're not supposed to trade with inside information, but we're not. We're trading what's on the chart. And as I'm about to prove to you, and you'll see this, I hope it'll be an aha moment for you, that you really can see it on the chart. We've just heard about the price of gold and silver, specifically the silver market as well, being manipulated. And you can see clearly how they actually do it. So gold and silver was going to be taken down. Okay. So why is ultra-high volume very, very, I put that in the capitals, important when you see it, and what does it look like? Because it will often mark a top or a bottom on a price chart and give you an early warning that a trade is setting up against the herd. Ultra-high volume up and down bars, the first alert that a VSA sequence is setting up. How do we see ultra-high volume? How do we know it's there? We can see it with our eyes. We don't have to be clever. We don't have to be ultra intelligent. We don't have to have an IQ of 150. It jumps out on the chart. We can look at the chart and we can notice when we see unusual volume spikes appearing on our charts. That is what I call a telegram from the smart money. They're telling me they're active. I better start getting active with them. Because if I want to make money, I want to follow the smart money, not the herd. So the Yao Ming bar, okay, the skyscraper, the tall bar, the biggest bar on the chart, it's in volume that we're looking at. Volume spikes. Remember at the beginning I said that volume is activity. It's the activity of the professional money, the big money. And I promise you, you cannot get your head around the amount of large companies out there that are trading billions of dollars every single day. So, you know, you're trading, my trading, Tom's trading, we're just a blip on the ocean. We're nothing. We're a drip in the ocean. But we can profit from moving or following the movements in their moves. And in fact, this is Houston's Yao Ming. Yao Ming is a basketball player. He's retired now, actually, but he was the tallest, okay, player at the time in the NBA. 7'6". So I affectionately say to myself, well, if I imagined that an alien had landed in the middle of Chicago and Michigan Avenue, and I'm walking down, and the alien gets out of his spacecraft, never seen a human being before, but happens to know my name and says, Gavin, how tall are you? I'm actually 6'2". So I say, well, I'm 6'2". So the alien looks around and doesn't mean anything to him, to this alien. Could be a her. Doesn't mean anything, because there's nothing to compare it to. But then, if suddenly Yao Ming happens to be walking down Michigan Avenue and he stands next to me, and he's 7'6", and then my daughter Olivia, she's about 3 feet, okay, because she's only 4 years old. If she stood next to me, the alien would be able to look at me and say, well, you're pretty tall, your daughter's quite small, my goodness me, Yao Ming, he's really tall. Now, here is the silver chart on the day that Andrew Maguire said gold and silver were going to be taken down. And both charts, both metals are manipulated, okay? And so remember, Maguire said a number of things were going to happen in advance of them happening. First of all, we notice Maguire said the manipulative event was going to happen on the 5th of February, okay? That's that bar just back there, right there where the high volume is, okay? See that high volumes? There's your Yao Ming bar. The manipulative event has taken place. Now look at what's happened on these two bars, that one there and that one there. All the previous support where silver had been supported has been breached by this high volume. So they've instigated a whole load of sell orders and then bought them all back at lower prices. And that's how it works. And then we've got a signal down there. You may be able to see it. It's called a shakeout. A shakeout. Now a shakeout does exactly what it says on the tin. It gets rid of anyone that was long or short. It tries to catch any near stops in the market, but after you see a shakeout is where you're going to make money. Because the shakeout, which is a sign of strength, SOS, a sign of strength, will most often reverse the trend. And where you trade a shakeout is any signal that you see, as long as the bars are green and the diamonds are green in the software, any sign of strength is a good place to go long. Any of these. These were the first two. That's where I went long, right here. But these two would have been acceptable. And the reason is, as I'm about to show you, there is a trade setup that we see after a shakeout that's explained in my second book that we're going to give you. And it's called a test in a rising market. Yeah, Joe says, good that you're contributing here, Joe. I get it. There are more stop orders to run than there are target sell orders to grab, which works to their benefit. Yeah, absolutely right. Yeah, what's going on here? A shakeout is market manipulation 101, as I call it. It's a group, or in this case, two large banks with a lot of money coming into the market, massively selling into it, catching any stops, and then buying it all back at lower prices. And you can see they cannot hide their footprints in the volume. They try, but they can't. They can't fool VSA. One of our strongest signals is the shakeout, and it's one of the principles that I want to talk about now. It's a key principle, and if just from this course you learn this signal, you'll learn how to make a lot of money to the long side. Because when you see them in all markets. Shakeouts are very, very common. Even the last couple of weeks in the S&P, we had a shakeout. So they're very common. And they're very good if you know how to trade them. Here's how we trade it. Number one, we look for ultra high volume. That's the first thing we're going to do. We look for what we call the Yao Ming bar. It's the first part of the sequence. The first part of a VSA trade setup starts with ultra high volume. When I first moved to Chicago, there was a saying that everyone in Chicago used to say. They used to say, "What's going on? What's going on?" Everyone come up to me, "Hey, Gavin, what's going on?" And I used to say, what do you mean, what's going on? Well, when I see ultra high volume on a down bar like this, I say to myself, what's going on? Because something's going on. Professional money have become very, very active, and they've become active for a reason. Now, when they're active, it's time for me to get active because the market's going to move, and I want to participate with them in the move. So here we see the shakeout. Now, do I want to immediately buy on the shakeout? Now, Tom Williams often does. I don't. As you'll learn next week in part 3, I'll show you my trading plan. I'm a little bit more patient now than I used to be, and it saved me a lot of money because being impatient can actually cost you money. So here we have a shakeout, and it's a massive volume on both days, the day before and this day, but we notice the key to this is the next bar closes higher after we see the shakeout. Now, we must always read the dialog boxes that come with the Trade Guide software. If you haven't got the software or one of our plugins and you're on this course, you are entitled to a discount, and you just need to email me if you want to. Someone just said you haven't got the software. You can get a discount. Yeah, you have to email me at that email address and just let me know what you're interested in, and I'll connect with you. But the shakeout has a description, a dialog box, and it says here, a shakeout is a markdown on a wide spread closing up near the high. In fact, this one closed up actually near the low, actually, but it can close up on the high or low. And it's to shake out weak holders. If volume is low, supply is dried up. High volume, which is what we had here, suggests demand overcame supply. But remember, this supply will hold back future upward progress. If the spread is narrow, it will have less impact. Now, in this interest, this example, we have quite a wide spread. Now, the market moves up almost immediately. But when it retraces, we have very, very light volume on the down moves. And here again, look, notice as we come down, notice the volume declines as the market falls. After you see a shakeout, we're looking for a place to enter the market. So now we're going to talk to you about a trigger number. Now, a trigger number is where you get into the market. This is where you've now got enough evidence, okay, evidence that the market has changed behavior and is moving in the right direction. Yeah, Joe just said, oh, great, okay, Joe, thank you. It's helping me greatly by understanding shakeout rather than being affected by it with panic. I can react with logic rather than emotion. Joe, if you can learn that from this course, it'll be worth the money you spent, because emotions are actually our worst enemies as traders. Right, Peter's asked a great question. Does the professional money communicate with each other and coordinate, plan these manipulative events? And the answer, Peter, is sometimes, not always, sometimes. In this instance, it was widely reported in silver that 2 institutions, HSBC, which are a large bank, and JP Morgan, coordinated this deliberately. So it does happen, but not always. Remember, Tom once said to me, I remember sitting down with him trading one day, he said, Gavin, if you want a friend in the stock market, buy a dog. He said, because there's no one out there who's going to help you. And in fact, he wasn't quite correct, because Tom Williams taught me pretty much everything he'd learned in his 30 years of trading. And there are people, there are good people out there that will educate you and tell you the truth. But there's more snake oil people in the trading business than any other business I'm aware of. It's amazing how many scams there are out there, how much rubbish there is out there. But when we read volume, no one can argue with the truth, and the truth is right in front of your eyes. And if you go to the internet now, we are blessed with so much good information on the internet that we can make our own judgments. The problem most new traders have, and even experienced traders, is they let their emotions get in the way of logic. And that is where problems come in. Now, someone also said to me once, they said, well, Gavin, you know, the smart money, the professional side of the market, why do they manipulate the market? Because they can is the answer. And you know, you'll hear very often when they get caught, they don't admit guilt, they just pay a fine. But ironically, the fine is much lower than the money they made manipulating the market anyway. So they do get fined, they do get caught. Some people even go to prison because they've manipulated the markets. There's been some famous examples in the last 6 months. But what we're interested in, we're not interested in the whys, the wherefores. We're interested in, can we legally and ethically take a trade in harmony when the market is being moved by professionals? Now, here is how I define a trade setup. Now, first of all, we observe the shakeout bar, which is where my 2 lines are drawn off. You should all be able to see that. Now, the most important part of that shakeout bar is the top of it, the black line, okay, just here. And the reason is, once the market penetrates it and goes up through it, as it does here, with that amount of volume behind you, you've now got what we call strength in the background. That has not disappeared. That volume is not gone away. We know that as the markets come down here, we've got 2 more signals of strength. More volume comes in. There's more buying here on that bar. The market goes up, it comes down to the top of this bar, but look at the volume now. As it's coming down, the volume's getting lighter and lighter. That's what we call no selling pressure. Now, the market then begins its rally, but it doesn't just take off to the moon instantly. You've still got buyers and sellers interacting all the way along here, but that's the great move. That was the move that you wanted to catch. Because once it broke out above 20, can anyone tell me where silver went to? Anyone have a guess where silver went to before it was sold? Anyone have a guess? Where did silver get to after this shakeout? Peter's got it right. Well done, Peter. You get the golden star. Mark, you get a gold star. Well done. Almost 50, yeah. It went to almost 50. And do you know why 50 is significant? Why $50 an ounce of silver is significant? Right, I'll just show you very quickly, just out of interest. Yeah, well done, Mark. You got it. Spot on. I didn't know if a lot of people don't know that. Okay. Yeah, well done, actually. Peter's got it. Mark's got it. Both of them. Okay, yeah. If you type in Hunt Brothers and silver, and we click here, this is very interesting fact, absolute fact. Okay, the price of silver in 1980 on Thursday went up to $50 an ounce, $48.70 in fact. In 1979, the price of silver jumped from $6 to a record high of $48.70, which represented an increase of 712%. The Hunt brothers were estimated to hold 1/3 of the entire supply of silver. Now, you may ask yourself a question. You may be sitting there scratching your head going, hold on a minute. If silver was $48.70 in 1979 and 1980, how come it's still at $50 or near there? It's at 30 at the moment in the year 2012. It's been artificially manipulated. It's been squashed. Silver should be, if you look at with inflation, now trading around $400 to $500 a troy ounce. Does anyone know what the price of silver is today? Anyone got any ideas? Let's go and have a look. $32. Actually, that's the ETF, but yeah, about 34 bucks. So now try and make sense in your own mind of that. Here we have the story of the Hunt brothers who manipulated the silver market back in 1980. I think I was at school then, and it went to 48.70 a troy ounce. And then if we look at silver, and we go to the weekly chart of silver, which we can do, and we look at the very high, which has got a signal on it, by the way, right here, and we look at where it goes to, 48.35, professional sold at that level, and it was the two large banks that came in back there in April of last year and sold silver, and you had a signal on it the week before the biggest fall in silver that we'd seen for about 6 years. I hope you're starting to understand this. The market's gone up. The news is that silver's going to $200 an ounce. It gets to the 1980, okay, the 1980 high and collapses. And that is going to keep going. That's not going up. That's going to come down further. I think we should be looking to find silver at around $25 an ounce over the next 3 months. Now, we may have an upthrust, which is what these bars look like. Okay, we'll talk about upthrust later. That's what I'm looking for over here. So I'm expecting higher prices in silver before I'm expecting more lower prices, because remember, professionals sell into up moves. So where do we buy silver in this instance? Well, you can buy it on any of these green signals here. You put your stop loss one tick below the high of that bar, just a couple of ticks below. It doesn't have to be high, because it very rarely comes back down into those levels. Not always, though. There are examples where you will get stopped out, but it'll be a very tight stop once you've got in. And here, my favorite signal, a test after a shakeout. Now, all the indicators in Trade Guider have got a number. In this instance, it's SOS, which is in green, which is a sign of strength, a test after a shakeout. And what makes that a great signal to go long is it's penetrated the high, or the market has rallied away from the shakeout area, which makes it a strong market, not a weak market. So therefore, we've seen here, we've proved, I think beyond reasonable doubt, that the market was manipulated, that it was two large international banks that did it, that it was reported by Andrew Maguire 3 days or 2 days before the event happened. The event happened exactly as he predicted, and Trade Guider produced a series of signals which gave a setup. And better than that, I actually connected with Andrew Maguire in 2010, and he presented at one of our shows, one of our live mentorship shows that we do. And he actually said, when he saw the software, he's got a copy of Trade Guider, he said, that's amazing. He said, there's no other software that he was aware of that would pick up this type of activity. And that's true, because most software is looking at past price. It's not looking at volume at all. Most software doesn't use volume. I find that amazing. But that's why we're very unique at Trade Guider, and we teach something which is the truth. And it's all there in the chart. So always be contrarian. You know, I never was. Coming from the system, as I did, being a former policeman, I always think things are very orderly and very, you know, the government looks after us, all of this stuff. But actually, I started to realize that there is a lot of manipulation, especially through the media. The information that we receive is not always for our benefit. So we must be contrarian, especially if you want to be a good trader. You can either be the sheep or you can be the wolf. It's your choice. I prefer you to be the wolf and actually make sure that you understand what the market's doing. The truth is that in August of 2011, the US was downgraded, and the message was buy gold and sell stocks. Can I just ask, do you all remember that? Everyone last year, 2011 in August, buy gold, it's a safe haven, and sell stocks. Do you all remember that? Yes or no? Just type in yes. Do you remember that? That was what we were being told. That's what the media were reporting. They weren't lying to you. They just didn't understand the chart. On that same day when that downgrade happened, I began to follow the charts, and I do a YouTube channel. Some of you are aware. This is what actually happened. With the benefit of hindsight, we know what actually happened. Gold, by December, had hit a 6-month low. So had you bought it at a safe haven with a stop loss, you were out the market. You'd lost money. The stock market's hit an 8-month high in March of this year, and they're still going up. That's a fact. Now, if you put 100 human beings in a room, traders and investors, and you ask them about sentiment at the moment, they'd all be gloomy. But you've all typed in, we're in a bull market. Not one person said bear market. And that's how the markets work. They go up after bad news, and when news is bad, and they get sold on good news. So remember, your emotions are key to your success, and you have to learn how to control them. It's very easy for me to say that because I don't know, you're all individuals. The way I've learned this is to look at the facts in the past. If I sold gold in 2011 at the high, I'd have made a lot of money. I actually have made quite a bit of money on gold shorting it. The stock market has rallied. If you'd have bought Apple in August of last year, you'd have made 268%. That's a fact. Apple went up to 700 from a low of about 400. Now, this is all provable. Everything I'm saying here, you can go and check for yourself. But the chart doesn't lie. Unfortunately, the news influences all of us, and the smart money are fully aware of how the herd think and act. You must not be a herd member. Peter says, do I watch the news, CNBC, while you are trading to know what not to do, or do you ignore it altogether? I do listen to the news, Peter, and the reason I do is because I then look at the impact on the chart. So let me give you an example. If I see bad news about an instrument, a stock, like my favourite's JP Morgan, actually, that's the one I trade a lot. If the news is really bad, the price collapses. This happened only a few months ago, in fact. I'll give you an example. Let me show you. I'll give you an actual trade that I took, and you can actually see this for yourself. Okay, right. May of this year. All right. Now you can see here I've got 2 lines drawn here, but we had a big gap down, and this was where the news was that JP Morgan, one of their traders in London, I believe, had lost the bank $5 billion, I believe it was, or $2 billion, whatever it was. It was a very bad news story. Now, look at the volume here. Now, first of all, I didn't go long on that bar, and there's no signal on that bar because it's actually a weak bar, because it did actually at that moment take out this price support, and then a few days later we had an upthrust and it kept going. But it kept going and kept going and kept going, and at no point did I see a clear bottom formed. None. Nothing obvious that was marking this bottom. But I knew there had to be some buying there because of the volume. But I thought, well, let's wait to see if it recovers. So the next biggest volume bar was here, potential stopping volume. But it didn't stop the market there. But then what happened, a few weeks later, the market began to change behavior. And we began to go up, as we can see. And it went sideways for a while. Then it came back into this area here. But this time we had a much more interesting signal. The volume was pretty average, but it closed up on the high of the bar. This is called a test. Now, tests can have 2 outcomes. They can succeed or fail. In this instance, the next day, the price closed higher meaning that test had succeeded. So this meant that obviously some group or groups had tried to accumulate along this line, and it wasn't clearly obvious at that point. But then the market had a big spike in volume, so we had a breakout trade here. Now, as that spiked, the signal to get in was right there, and that's called no supply. And the reason that was a good long trade at the time was so I had a clear stop that I could delineate with my H stops here, which I'll talk about next week. But look at the low volume here. Very low volume. As the market tried to fall, very low volume, and more buying came in, and that produced a very nice up move. And then, believe it or not, it came right up to 43, which has been a previous resistance level up here, and it's come off that, as you can see, but it's trying to break out towards the 50 level. And if it gets up to 50, which I think it will, it'll be another great short. So, let's go back to the PowerPoint for a minute. So, Peter, the answer is the news, yes, I watch it, but I trade the chart. I trade the chart. The news about JP Morgan on that chart was very bad, but it took about 6 weeks before a trade setup appeared. 6 weeks I had to wait, but I knew on that news there'd be some support. So, August of 2011, gold collapsed and stocks rallied. That's a fact. We can see here the buying at A and B on the bad news, but notice, it's always very important to notice when a market falls to an area of high volume, and the volume is now lower than this area here, it tells us there's lack of selling pressure on the market. And the clear signal to go long was actually in here. Because as the market had its decline, it declined on the lowest volume of the year. And that's telling us there's no selling pressure on that market. There's lack of interest, okay, to the downside. And then the rally has then been maintained. As we know, we're up at 1400 now since I produced that slide. So, as Mark Twain has said to us, if you don't read the newspaper, you're uninformed. If you do read the newspaper, you are misinformed. Mark Twain, what a great guy. What happened? The truth is always there. September of 2011, 7 weeks after everyone was told that gold was a safe haven, the truth is printed in the New York Times. A gold rush wanes as hedge funds sell. Is the smart money fleeing gold? Of course they were. Gold went down to a low from 1920 to 1550 in 6 months. People got killed. The herd got slaughtered because they didn't know how to read the chart. Indeed, I went on YouTube to warn people out there of this impending fall. Why? Because I had a chart. This is a chart of the monthly chart of gold. One of my favorite signals in the software, SOW90. Hidden selling. Ironically, look at the volume. The highest volume for 8 years. Professional money was selling gold. And that has not disappeared from this market, which is why gold's refusing to go up. It's tried to go up. It's gone up to 1730, 1740, but it hasn't gone back up to that 1900 level, and it's going to take a lot to get through that level. Because we now know, in August, the smart money, who are clever, were selling their gold to the buying public who were told it was a safe haven. As Richard Ney said, wake up. Once you understand this, you'll have this knowledge with you, as Tom always told me, for the rest of your life. And it's very powerful knowledge. There's my YouTube video. It's had about 6,000 views now. So I actually filmed that on August the 25th. And I warned that gold was weak, not strong. And I showed the chart. And I did so to help my fellow traders and investors to warn them. But most people don't listen at the time. In hindsight now, they know that that was correct. But it wasn't just me guessing. The chart told me there was selling. Just here. Sign of weakness 90. Weakness, remember we said at the beginning in this foundations course, appears on up bars. Look at what the next bar did. It closed near the low of the previous month. That cannot have been buying volume, can it? And it even closes off the top of the bar. It only closes about 75% up the bar. And as soon as that next bar began to fall, I knew that they had sold into that rally. And that's how the markets work. You sell high, you buy low. But a lot of the general public were misinformed, as Mark Twain said, because they bought gold at the wrong place. I mean, look at the headline here. This is how the news affects you as an investor and a trader. You get news. You know, oil prices slide. Spain bailout talks imminent. Yeah, the safe haven, gold. Okay. 8th of June. Oil prices hit a 17-month low on China slowdown phase. So you've got the oil market collapsing. Okay, but gold actually fell. Sorry, there we go. Gold fell 14%. Okay, now it says it's fared better. It hasn't fared better at all. Okay, a fall of more than 20% for its peak price, often defined as a bear market. So we know that when a market is being, when the public are buying into a market, you should probably be selling to the public. And that means you, the wolf, not the herd trader. And when the public are panicking and selling their perfectly good stocks, then it's time for you to buy. And don't get involved with the emotion. Okay, so another example for you. This is a bit further back now. We're going back to 2008. This is a clear example of where you see no demand for something. An oracle of oil predicts $200 a barrel of crude. Do we all remember this? Back in 2008, oil was supposed to be going to $200 a barrel. That's what we were told. It was trading about $140 at the time. The chart will never lie, I say. What are the smart money actually doing on this news? May 21st, 2008. Arjun N. Murthy remembers the pain of the oil shocks of the 1970s. He is bracing for something far worse now. He foresees a super spike, a price surge that will soon drive crude oil to $200 a barrel. Mr. Murthy, who has a bit of a green streak, is not bothered much by the prospect of even higher oil prices, figuring it might finally prompt America to become more energy efficient. An analyst at, Goldman Sachs. I wonder who would profit from shorting gold. Hint, hint. An analyst at Goldman Sachs, Mr. Murthy, has become the talk of the oil market by issuing one sensational forecast after another. A few years ago, rivals scoffed when he predicted oil would breach $100 a barrel. Few are laughing now. You get the gist of where I'm going with this. Okay, he's made so many great predictions. Okay, well, let's see what oil actually did. Well, first of all, the CFTC began to see that a lot of oil traders were manipulating the price of oil at this time because a lot of airlines had gone long oil. They'd gone the wrong way. Does anyone know which airline, just out of interest, hedged oil and gasoline prices the right way? There was one airline that got it right, and it enabled them to keep their prices low. Anyone know which one it was? Yeah, well done, David. Absolutely right. Yep, well done, Mark. Spot on. Yeah, it was Southwest Airlines in the United States. They hedged south. They went, no, oil's not going to 200 at all. I think one of their directors was using VSA personally, but there we go. But seriously, no, we see here a report that oil was being manipulated, that traders were shorting oil, not buying on all this news. So what did I do? As usual, I do a YouTube video in advance of the move, not when it's happened. In July the 17th, 2008, I did a YouTube video about the crude oil. I said, it's weak. It's being sold. I said, look, when weakness appears, it appears in an up bar on high volume. I forecast there gold would fall to $100 a barrel. I actually got it wrong. It went much further. Anyone know what price oil went to after Arjun Murthy's report? He said it was at 147 at the time. He said it was going to 200. Do you know where oil ended up? Anyone got any ideas? Have a guess. Within 6 months of that news report, where did oil get to? Anyone know? Mark, you're pretty close. Okay, well, after that news report, oil collapsed and went down to $33.55. Here at the top of the market is 3 signals. Look at the market goes up. There's your selling in that volume. And as it tries to rally at 147, the volume disintegrates. There's no demand. No one's buying oil up that price. They sold it in the background on all that news. Just here. There was selling all across this top. It goes up. There's 3 signals that are explained in my book, in my second book that you're going to get. And what do we see here? We see a clear example of no demand for oil. And what happens to the price? Look at that for a nice trade then. So imagine that you're short on that news. So you read Mr. Murthy's report, it's going to 200, and you go short. Look at it. How much money could you have made on that trade? And you see this happening all the time in every commodity market, in every stock market, in the currency markets. Very, very, very common. Remember, the news is not there for your benefit in the stock market. Never has been, never will be. It's probably going to wrong foot you. Now here's a great example of how our scanner in TradeGuider picked up the plummet in silver a week before it happened. A week before it happened. Now we have 2 scanners in the TradeGuider program that scan the markets. One of them is an indicator scanner. And the indicator scanner works in real time or end of day mode. I'll actually do an indicator scan in a minute on the S&P so you can see what it looks like. So silver plummets 27% in 1 week. You could make 10 years of salary on that trade if you got it right. And could you have got it right? Well, a couple of customers of ours did get this right. This is the indicator scanner in TradeGuider end of day. Now you can use it in any market. You can use it in stocks, futures, you can even use it in Forex because we've got end of day Forex data. It's very valuable when you can actually see when there's a cluster of indicators at the right edge. Now what I'm going to do, I'm actually going to show you a scan, an indicator scan. We're going to do one live for you. So we'll do something now that's right edge of the chart rather than looking at PowerPoint. And we'll do an indicator scan here. Now I'm using TradeGuider end of day version 4, okay, which is the latest version that we've currently got. Click on indicator scanner and it says create a new scan profile. Now the data I'm using in here is from Thomson Reuters Metastock. Okay, now it's going to ask me what I want to see, and it's going to ask me how many bars of information I want to scan, or how many bars of information I want to see. Now I want to usually look about the last 2 weeks, so every bar represents a day because this is end of day, daily charts. So let's put it down to 10 days of data. Okay, so I'm going to look for any VSA sequences in the last 10 days of data. I'm also going to look at is there any trend changes in the trend channels, because we have blue arrows that represent trend change indicators, and I'm going to show you. So if we change from a downtrend to an uptrend, and I've got VSA indicators in the background, I'm going to be interested in if it's green going long, red going short. Click on next. Okay, so it's saying on the next page I'm going to choose the charts to be scanned. Okay, so what do I want to do? I want to add a complete watch list. Let's scan the S&P 500. Okay, let's go for the S&P. We could scan any of these, we could scan the energy futures, we could scan the NASDAQ, we could scan the New York Stock Exchange, and you can add as many watch lists as you want. But we'll just, for the moment, add the S&P. Click on Next, and we'll call this Foundations Course Scan. Okay. Now, what the computer is now going to do for me, it's go and search all the stocks in the S&P 500, and it's going to find any clusters of indicators within the last 10 days. And if we get them, that's a very high probability trade setup. So, while we're doing this, is there any questions so far about what you've seen? Any questions at all? Because this is going to take about 3 or 4 minutes to do. So if you've got any questions, now's the right time to type them in. Okay. Okay. David, I've got some duplicates in there because I've actually got some of my stocks that I follow I put in the scan as well. So there are a couple of duplicates in there. That's why there's 507. Yeah, there are actually only 500 in the S&P. You've also scanning the parent index on there as well. So it's 501 usually, but that's why I've got some duplicates in there. Peter says, so if you think the S&P is going up from here, do you assume the fiscal cliff will be avoided? Peter, I don't really care about the news and what they say about fiscal cliffs in Greece. And I mean, look, the news is pumped out through government officials to the media to keep us in fear. That's really what it's there for. Keep the public worried, concerned, in fear. There's no news in good news. A fiscal cliff, what is a fiscal cliff? I mean, I don't want to get into the whole whys and wherefores of the whole financial system, but I do understand how the whole Federal Reserve System works and the banking system works. And at the end of the day, it's a giant Ponzi scheme is what it is. And the central banks can just make up money as they choose. I mean, they just print it. I mean, where do you think Mr. Bernanke suddenly gets, you know, $20 billion from? He puts a zero on the end of a number in a computer. So I'm not too concerned about fiscal cliffs and all of that stuff. Everything gets resolved. It's human nature. They have been for centuries. You know, if you look in 1974 and look at some of the crises that we went through in 1974, certainly in England, when there was no petrol and all of that, we get through them. But I'm not worried about that. I look for good quality stocks to buy for companies that are innovative, like Apple, like Google. I look for companies where I can see on the chart clear indications of professional money buying or selling. And I don't really care about fiscal cliffs and all of that because I can't control it. It's not within my control. What I can control in my trading is my VSA trade setups and my account. That's within my control. I cannot control the fiscal cliff, so I don't worry about it. I don't even think about it. I'm just concerned with making money trading. And that's really, I mean, I'm not a politician. I can have opinions on things, but I've learned, certainly in my life, to be successful, focus on what you do best, focus on your own individual life because you create that, and the news is there most often to keep you suppressed and to make you feel pretty negative, and that's actually not. Yeah, Sharon, I saw that. That's not a problem. No problem at all. So my advice to you, Peter, again, is I don't like to have an opinion on this fiscal cliff issue. It's the same. I've been asked, is Greece going to leave the euro? Well, it hasn't yet, but it was going to 2 years ago. But they use the news every few months to put panic in the market to make money. You get news that the euro is about to disappear, but the euro has rallied. It's gone up, not down. So the news can't have been correct. So I always trade the chart. The chart doesn't lie. And as regards to the news, don't really worry about it. Sharon says, how refreshing, we don't need to worry about the news. Well, it's funny, the reason I say that, Sharon, my mum is a newsaholic, if you want. All she does all day, sits down and reads and watches CNN or BBC, whatever. Every time I go around and see her, I knock on the door, hi Mum, how are you? I'm always happy, I'm always like really positive. She said, oh Gavin, isn't the world a terrible place? Oh, what a mess. Oh, have you seen what's happening in Israel? I'm like, Mum, no. I said, world's a great place. I've just been with my family. We just went for lunch. We went for a walk in the forest. I said, no, it's a great place. It's how you see it through your own eyes. It's how you create it. It really is. And yeah, the news is it. But if you never had a television, you wouldn't know what was going on in most of these countries. You'd have no idea. Will delayed trades affect VSA signals? No, Ian, they won't. Good question. Because at some point they're going to be reported. Even if they are delayed, they show up in the volume. And when they show up in the volume, it reports through the exchange, and we get a signal. But the other thing, Ian, to keep in mind is we use relative volume to the previous bars. So we don't, even if they try and disguise their trades over a couple of days, we still get signals. And I don't really know why that works. It's a very interesting situation that we have with trade guidance, but it does work, no doubt about it. I'm seeing a few good signals on these charts right now, actually. I'm seeing some really nice things here. Right, we're nearly finished on this scan. Okay, all right. Can everyone see my scan? Can everyone see that? Okay, I'm going to show you that now, Sharon. I'm going to talk about that right now. You mean this here, Sharon? You mean this volume thing here? Yeah, that's what we call a volume thermometer. It measures bullish versus bearish volume. I'll show you that in a minute. Let me just show you here what we've done. Now we're going to go back to remember the foundations of VSA. Everything starts with a sequence of events. Now we notice on this chart here the S&P is rallying at the moment. There's the last green indicator, just there, and we came down a little bit and then we've gone straight up. It looks like it wants to come back down again though, because there's a lot of volume on that bar and we've hit the underside of a trend channel. So it could come back down a bit further for more buying, very possible. But what I want to find out is there any stocks then that are acting stronger or weaker than the parent index that they're in, and is there any clusters of indicators that show me there's a buying opportunity. Now they've got a couple here on Apple. Now when I left click the indicator, there's a couple of, now that looks potentially pretty bullish. Now what do we have here on Apple? Have a lot, in fact, as we've picked this out of the scanner here, this is a great one to examine and to study. Okay, so let's switch the scan off now. Now what do we notice? Here, in this big uptrend of Apple, we've got support around 523, 524. We've got a signal down here, and it's a really nice one. This is a very high volume test, and the market's responded very positively to this test. Now it's also trying to change trends. See these little diamonds have turned yellow? Sorry, white, beg your pardon, not colorblind, white. That's showing me we're trying to trend up. Now, from here, from this upthrust, which we're going to talk about later on, this marked the top at 700 of Apple. They had a pretty high volume upthrust, which is where they mark the market up, but it closes on the lower of the bar on high volume. Now, this, Sharon, is the volume thermometer. Watch what happens to the thermometer as the market goes into these red diamonds. You'll see that at the moment at the top there it's bullish, but as it falls, it measures several bars, as you can see, and shows me bearishness. And that's where I go short, is when we see the market bearish here, you can stay short in any of these moves. See, it's now gone below the 50% line. It keeps coming down, stays bearish, so I'm still short, still short, still short. Now, look what happened on the signal. See how we've gone green here? It's showing me buying volumes coming in. We've now gone below 50, above the 50% line. Now, we're just building a cause to go up, and we're right on the 50% level. That would be worth certainly watching on Monday. If that attempts to rally above the high of that bar, which is 588, and gets up towards 600, then we could see a nice little mini 50% retracement up to around the 630 area. So that would be one to trade. In fact, I may well trade that next week. Now we've done that scan. I didn't plan to do that scan live, but it's a good one. So that's how we use the scanner. Now, in silver, the software did a scan and picked up 8 indicators in a line. Okay, 1, 2, 3, 4, 5, 6, 7, 8. 8 of them. Now that's highly unusual. I know something's going on, and when you see that, there's an opportunity to make money. So here's what happened. This is the actual chart. At point A, remember I said weakness appears on up bars. We'd seen all of these in the scan. 1, 2, 3, 4, 5, 6, 7, 8. And we had our biggest. So is market weakness predictable in advance? Yes. But we'll look at the volume at point A. Absolutely enormous. Now observe a number of things about that price bar. The spread is quite wide. So the range that we talked about, which remember when we talked about volume spread analysis, volume is ultra high. The spread here is the high and the low. So it's quite wide, but look at the close. Right now, down the bottom 25% of the bar. Only one thing can cause that. That volume has to be supply, sellers, overcoming demand, buyers. Sellers are coming in. And the scanner has picked that up perfectly. It's one of the strongest signals in the software. It is called a buying climax. A buying climax. It means exactly that. But look at where it came in. Exactly where the Hunt brothers had put the market to in 1981. Now, armed with this information, if you saw that and you knew that the Hunt brothers had got up there in 1981 and you saw a buying climax, you just now want confirmation that the market's weak. Well, you get it. At bar B, we have what's called an upthrust. Look at the bar. The volume is high, very high in fact. The market, or the spread is pretty wide, but look at the closing price. It closes on the low of the bar. Finally, at point C, you have the completion of the VSA trade setup. This is called low volume, up bar, narrow spread, no demand. But it makes it a great short because weakness on point A. Now the markets move because there are 3 universal laws at work on the charts. You might want to write these down. This is exactly what Wyckoff taught us. They are the law of supply and demand. I think everyone understands that. We hear about supply in oil and the housing market and all of that. We also hear about no demand. It means no one's buying. So supply and demand is a universal law of the charts. Then we have 2 others you may not have heard of. Cause and effect, and effort versus result. Cause and effect, effort versus result. The cause and the effect is simply the activity of the smart money, the buying or the selling. The effort is seen in the volume. The result of the effort is seen in the closing price. So we can infer on bar A there is an awful lot of effort in the market to do something. But the result is the closing price has closed on the lower 50% line of the bar. So that's 50% of the bar, it's closed below it. So therefore, we can determine on that bar that sellers are overcoming buyers. Because if that volume was all buying from professional money, or a lot of it, we would close up on a high here. But what confirms it is that bar there, because it closes lower. That's the first part of a VSA trade setup or a sequence. At bar B, we have the upthrust. That's the market maker trying to get rid of any more sell orders to anyone that's willing to buy. And there are buyers up there. And the reason there are buyers trying to buy into this market is because they're foolish. They have heard that this market is going to go to $100 an ounce. You know, they're told it's a safe haven, that the metals are going to be bullish. All of this rubbish. At point C, we have confirmation of what we've seen at A and B. We've got no demand. There's no volume now. Look, lowest volume for days. That's the market maker desperately trying to hold the market up. But the professional money, as the market's gone up, they've just withdrawn all their interest. We don't want higher prices here because we've already sold on bar A. If we've sold on bar A here, we're hardly going to get involved in the market 5 days later as it's trying to go up. Bar D confirms the weakness, and the result is the biggest one-day fall in silver seen for years. That was a very profitable trade. And the reason is it's all there. And you'll note that the week before silver fell, we had 3 or 2 indicators that form part of a sequence. And now silver's currently trading around this level again, around 34. So if we see no demand in the next few weeks, we can expect it to fall. Another example. Now this is an upthrust. Here's how, again, news affects people. Warren Buffett is one of the greatest investors in the world. Obviously, he's the smart money, isn't he? He's a very clever guy, very shrewd. Buffett invests $5 billion in Bank of America. That was on August the 25th of 2011. Let me ask you all a question. Do you think the stock went up that day or down? Did it go up or down on that news? Just type in what you think. Did it go up or down? What do you think happened? Just type in. Did it go up or down on that news? Okay, several of you said it went up. One of you said it went down. Well, it actually gapped up. There's the day that we produced our signal. Look at the volume here. Just like silver. News is good. Buffett's come to the rescue. Bang. This is a great opportunity for the smart money to sell to the public who have watched the news. Well, if Buffett's buying it, I'd better get in. But look at what happens. Great opportunity for professional money to sell. So they sell into the upthrust, and as the market tries to go up, look at the volume, and then it has a massive fall. I hope you're starting to understand this. This is how news encourages you to make poor decisions in your investing and your trading. The chart doesn't lie. That was a great short. Great short. The best place to have shorted here was on that bar there, no demand. Because after that massive volume, the market's trying to stagger up on very, very light volume. There's no interest at all in higher prices at that moment, and the price collapses. It's a short, not a long, but the news is bullish. Eventually it will recover, and it has. But at that moment in time, it was a great short trade. So it says numerous studies have shown that mutual funds overseen by professional stock pickers often are outperformed by computer-driven index funds. The record for hedge funds hasn't been so impressive either. Since 2008, when the number of those funds hit 10,000, nearly 3,000 have gone out of business, says Hedge Fund Research in Chicago. This is important, this next statement. The edge is hugely exaggerated, says Richard Ferry, founder of the investment advisory firm Portfolio Solutions and an advocate of low-cost index funds. If the small investor does the right thing, he or she, I'll add, can do better than 99% of anyone else. That's you and me, ladies and gentlemen. If we do the right thing, we can do better than 99% of anyone else, and that is true. Doing the right thing, however, means understanding when to buy and when to sell. Most people, says Buffett, get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what's popular and do well. Think about that statement for a minute. Most people get interested in anything, gold, silver, when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. Great statement. So the markets, the reason that the VSA and the basics of VSA works is because we can understand why the market does what it does. The market works because human beings have two powerful emotions they have difficulty controlling: fear and greed. This is what Tom said. The market has to be fed losers. It is devious, and what you hear will often not be the truth. Well, I've never heard the truth about the stock market or any market on television. Just look at the news about the oil market in May 2008. Greed at the top as many traders piled in because they were told oil had to go to $200 a barrel. The chart never lies, and Gavin went on YouTube to show the end of a rising market. Then look at the banking sector in 2008 during September. Fear set in, and professional money began to buy, not sell, and that caused stocks like Goldman Sachs to rally 400%. It was all in this chart if you know how to analyze supply and demand. That's by Tom Williams. So how is it then that volume spread analysis identifies these moves? Well, again, I've repeated it a few times today. Volume is activity. We are interested in volume because it tells us the consensus of opinion amongst the smart money traders. The spread of the bar and the close in relation to the background information that we've talked about confirm their intent. So, what is a trade setup using VSA? Well, it starts with a sequence. Okay, it starts with a sequence. So, let's look at that. When we look at a sequence of events, I like to look at least 50 bars. Okay, I draw a horizontal line on the high, low, and close of the bar being observed, which actually I think Peter asked about earlier. I project a line out on the chart, which Trade Guider does automatically. Watch as price returns to any of the three levels. Look for more ultra-high volume or ultra-low volume at this level. This is key to the setup. So, here's an example. Now we note here that we have massive volume on this bar. This is the Euro-USD Forex chart. So first of all, I can see we're in a downtrend, and the market has clearly been marked up here. And you can see the volume is enormous. Remember, weakness appears on ultra-high volume Yao Ming up bars, as I say in this box. We're in a downtrend. Obviously, this is designed to catch anyone that's short. That's going to trap stops. But in the future, it'll give you a good trade. and it almost always does. Now we know I've got a trend channel from this high here and this high here. This is there. Watch what happens. The market falls. We have a little upthrust here, but then it goes back up into this level. But we get a series of red indicators coming in. And with this in the background, these red indicators carry a lot more weight than the green ones, because clearly that is an artificial markup. And when we see the market trying to go back up to these levels and the volume is very low, we know that the sellers are in control. So we call this ultra high volume, or weakness appearing, supply coming in, followed by no demand. And then the market begins to decline. And in fact, that kept going. It went down to 1.200, I think. It was a massive trade, but look at the volume. That is what we call Yao Ming. Okay, those are the things you've got to look for, Yao Ming bars. They're massive bars. They're very, very high volume bars. And when we see them, we must pay attention to them, because they're telling us something. They're telling us that the market is weak at that time. Here's another one that you can see. Now in this instance, the weakness has appeared here, right there. You can see there's Yao Ming again. You can see the next bar closes lower, confirming it. They hold the price up, so that's why I don't short instantly on these. I wait for the change in trend. Now here we get a number of things. This is a wide-ranging down bar, but it's taken out all this support. Now that's a very serious sign of weakness, which is why I then mark the closing price of that bar. The market then tries to rally back into this area, but look at the volume decline. That is a great short trade for a number of reasons. You've got weakness in the background, you're in a downtrend, you've taken out all prior support, and you're going up on reducing volume. That's called going up on no demand. There's no demand for higher prices, and you will get a great short trade in there. And you see this quite a lot in the currencies, but that was actually a UK stock that we saw that in, and that really was a very big move down. But it all started with Yao Ming, and I hope you're seeing now the importance of these ultra high volume bars. They're very important. Here we've got a slightly different setup. This is actually the flash crash, and you'll see that we've got at bar A the flash crash in the Dow. For those of you that don't know what the flash crash is, it was the biggest one-day fall in the S&P and the Dow. It was in fact a giant shakeout. Professional money were buying, not selling, believe it or not. They were buying into the market. Now, we mark the top of that bar here. We notice that as the market falls, the ranges of the bars begin to get narrower and narrower as the market exhausts itself. So there's basically no more selling pressure on the market. It begins its rally here. But in here, there's no real clear trades. But at this point here, the diamonds begin to clearly turn green. The bars turn green. They're proprietary systems built into TradeGuider. And we begin to rally away. As soon as the market penetrates the top of that bar, we know buyers or bulls are in control. Boom. And there's your indicator to go long. Right there. It's called a test in a rising market. And there are several others all the way up where you could have gone long based on the VSA principles. So what causes price to move on a chart? Well, the past price does not cause the future price to move. The price movement is caused by the activity, either the buying or selling of the smart money. This cannot be seen by analysing past price alone. It is vital to look at more than one time frame on any chart and to look very closely at volume, as we will now see. So how do we identify the smart money buying and selling? Well, volume is the gasoline that drives the financial markets. It's the key to the truth. Two very important points to always remember when analysing volume on your charts. Volume is activity. Volume is activity. As an estimate, about 85 to 90% of the volume seen on the charts will be from large institutional funds, such as George Soros, institutional banks, Goldman Sachs, and professional trading syndicates or pools who are nameless. Remember, though, Tom Williams used to work for one. ultra high volume and ultra low volume seen in the right place and back in context with the background of the chart are signals from the smart money of their true intentions. And these opportunities often arrive on earnings reports and news events, as we've seen. There are laws that govern the markets. 3 of them are on the chart. The 4th one is really the key. It's your belief in yourself and your ability to make money is the key to your success. That's something for another time, but it's very important to believe in yourself. So let's look at 2 stocks then to finish off with, which actually are my favourites. I trade both of these, which show actual examples of trade setups using the VSA key principles. Again, JP Morgan. Look at the news here. April the 14th. I've written about this in my book as well. It's such a good example, you can't leave it out of a foundations course because it's just such a good example. So the news here, very, very bullish. JP Morgan Chase reports 3.3 billion in profit. Not bad. Profit of JP Morgan Chase jumped 55% from a year ago to 3.3 billion on the back of the bank's Wall Street business and an improvement in the overall economy. Marvellous. Very, very bullish. Here is, on that day, the signals. Look at the volume. Massive. Supply coming into the market. Okay, so that's what it's telling us here. Supply is entering the market. Remember, the markets move on supply and demand. Supply here on this news is that sellers are coming into the market. Sellers are overcoming buyers because the buyers are the public. The sellers are the smart money. They've already bought at much lower prices. Now, what happens to the price? You can see it collapses. In fact, that goes right the way down to $33. But of course, the news is always good because professional money need to sell into good news. They can't sell into bad news because people won't buy. So they have to sell into good news, which makes total sense when you think about it. You know, if you want to buy something, you know, then you want to buy because you're excited to buy it. Quite right too. But professional money know how you think and act. And so they sell to you. And they sell in the volume, as you can see. Could that very same thing have happened 6 months before at exactly the same price level? Oh yes, ladies and gentlemen, it happens consistently. Everything is repeated in the market. Here we see, same news story. Okay, we see the date is October the 14th of 2009. JP Morgan scores big in latest quarter. Okay, that's pretty bullish again. Banking giant enjoys rebound in key areas such as investment banking, even as consumer credit issues persist. Look at the volume on that day, 14th of October 09. There's the date. Look at the volume. Look at the narrow spread. That's what we call the end of a rising market. That's into a clear, fresh area of price action. We've had a bull run behind us. We're actually the same level. If you projected that out, that's exactly what they did 6 months later on the same news. It's quite amazing how this stuff works. And so we clearly see there massive volume on that bar, closing in the middle, and we note that it's at a resistance level, which was in the past as well, and that's what happens. The stock then plummets, confusing everyone that went long on the news because there was an uptrend in place. Now they're scratching their head going, what the hell just happened? What the hell just happened? Well, you got caught because everything would have told you to buy at this top. A stochastic would have said buy. A MACD would have said buy. Most technical tools would say buy. The brokers that you talk to would have said bought. The newspapers have said buy. VSA would say sell. And VSA would be correct. Another example here, Friday, January the 14th. More news. More weakness comes in. However, notice the trend, the momentum here continues to go up a bit because we've had a big uptrend. So the momentum continues to go up. It goes right up to the same price level exactly as those 2 previous examples I showed you. We get there, no demand appears. Okay, no demand is no interested in higher prices at a previous resistance level. And the market then collapses. So the sequence is what we call distribution. And distribution is selling by the professionals. And if you can identify resistance levels in the background, as soon as the market begins to fall, goes through the top of that bar and then goes back up there on what we call no demand, that's a great short setup. That's a trade setup right there. If you take one trade setup out this course, that's a good one. Weakness in the background, the market almost mushrooms over. Forms like a mushroom top. And you want to trade anywhere in this area here as it mushrooms down, because the market's trending down and it's in the right place. Again, just to be a little bit pedantic, 14th of July, 2011. Again, the same news story. Here is where it happens. This time it's an even better trade, because on this date, on the 14th of July, we have what we call the upthrust. Now this again, if we look at effort versus result, the effort is in the volume. The result is in the closing price. And the next day we close lower. But this is great because it's at the top of a downtrend channel that I'd already drawn. So it's a very clear trade setup. No doubt about that. That's a high probability short trade setup. And that market then collapsed. Upthrusts, we see them all the time in charts. And you know, if you've got my book, and in my second book that I'm giving you, you will see examples there of what the upthrust means. The upthrust has a description box, and in the second book, you're going to get a copy of all these dialog boxes for every single signal in the software. And you'll be able to read each dialog box, and then when you've got the software, you'll be able to see them appear live and interpret them correctly. That's the best way to learn. And you can see here, I actually posted a video on YouTube. I think it's had about 7,000 views now, where I said to people, there's an upthrust in JP Morgan, the news is good, you've got to go short. And when you believe in the principles of volume spread analysis, you gain the confidence needed to make money in the financial markets. That's really what it comes down to. I'm in a live trading competition, I think on Thursday of next week. I've traded live many, many times. I trade my live account. I have a lot of success. I'm profitable. And the reason is I believe in the principles. I know these principles work. And there's another great example of another upthrust. We call these upthrusts and secondary upthrusts. And basically the terminology is exactly that. It's there to catch anyone who's long or short. If you're short, they use the upthrust to try to get you out the market before marking it down further. And they're very, very good shorting opportunities without doubt. Now we're going to overrun by about 15 minutes. I hope you don't mind. We're supposed to finish here in about 5 minutes, but I'm going to overrun a little bit because I've got a few more things I want to show you, so I hope you don't mind. So let's look at a place to go long. Now we talked a little bit about this earlier. We touched on this, which is British Petroleum. Okay. Oh yes, Ken, if you could, if you're here, I think Ken might be here. Yeah, if you, we're going to post a link now in the room for my second book. I just saw that now, Ken. Thank you. That'd be great. Yeah. So the link's coming up now. We won't email it to you. We're going to post it in the room here. So if you could do that, Ken, that'd be great. So here we see the news again. Very, very negative. Very, very downbeat. BP oil spill, absolute disaster, absolutely horrible. And yet the stock plummets. It plummets. We get a week of June the 16th. We can't cap the well, says BP. I happen to know we've got a guy that we met who's a BP engineer who was working out on the rig, who came to one of our seminars and said, oh no, we capped the well on that day, which is quite interesting. But the public were told we can't cap the well. So now we've got to look on the chart. Remember, we look for Yao Ming, don't we? Let's see if we can find Yao Ming on this chart. There it is. Look at that. All along here. So the news has been bad. Look at the volume on that bar. Now, even there, I would not want to go short, or long rather. I would be patient. But there's an observation, there's a clue that professionals must be buying here, because the next day we close higher. By the way, can you all see, can you just type in yes, can you all see the link to my second book, which is with my compliments? That sells on Amazon for $25 as a PDF, but you can have that. Can you all see that? Can everyone see that? I'll just wait for a few yeses and then we'll carry on. If you click that link, you'll be able to download it. The page goes blank for a second, and then it will allow you to download it. Great. Okay, good. And so here, this is the first phase of what we call accumulation. The market continues to go down. This time we get a narrowing spread with more volume, but this marks the bottom. And we begin to change behavior here. We start to make higher lows on the bar. So we now know that buyers must have stepped in here and bought BP, but we're waiting for a signal to actually go long, and that's it right there, as you're going to see. Here we note the market changes behavior, we change trend, and the signal that stops the market was what we call the selling climax. That is the end of the down move at that point. What happens, however, is momentum drives the market further down, which is why I don't just go long on a high volume down bar. I wait for the market to penetrate the top of that bar, which it does here, and start its trend. And then I trade any key VSA sign of strength to the long side when I see them. When we see climactic action, it means very high volume. That's really what it means. Ultra high volume is what we call climactic action. It really means everyone's involved. The smart money and the herd are all rushing in. And that's when we see a trade setup appearing. And then here we notice that in Trade Guide we've got these other indicators at the bottom of the charts here, which I don't use much, but they're there. And they're showing again, they're pointing up, saying that the market's changed trend. And they have changed trend, and the market's gone up. There's no supply. And when we see no supply now, it means there's no more sellers. That's really what that means. No supply is, it doesn't mean there's no sellers, as in there's none left. It's just there's very few, or the smart money are not actively selling there. And here we see we have an explanation in the dialog boxes, and that's the best way to learn VSA. That's how I learned it. Is just use the dialog boxes and use live charts if you can. One of the best ways to learn the volume spread analysis methodology is to do that. Is to learn actually live as the market's running live, and click on that. You just left click on the indicator here, just left click on it, and it brings up the dialog box that was written by Tom Williams and a guy called Philip Friston, who's a fund manager here in the United Kingdom. And then we can see any of these indicators here tell us that the market is beginning to move higher. And it does. It nearly doubles in value from the low, as you can see. And we can see here, every time in the uptrend that the market falls, the volume actually gets lighter. But it all started with the buying on the bad news that happened down here. And again here, even bigger clue that something was going on. If you put up the monthly chart of BP and go back 8 years to 2003, you can see a clear low defined here, here, here in 2009, and again here in 2010. That's what defined this market. So the clues were in the bigger time frames, which is why we'll talk about next week multiple time frame analysis, how to use more than one time frame. And we can see there that clearly there is clear support at this level, and that's where the smart money stepped in here and bought BP. Okay. Couple of other examples to look at for you. Now these, you're going to get these in the PowerPoint, so you don't have to worry about it now. You'll get them next weekend. But you can see here an example of weakness appearing, the upthrust, and the secondary upthrust. That's a trade setup. Right here, just learn these. That is a trade setup. Supply comes in, up thrust, up thrust. Another example, you mark resistance at a previous level where the price has refused to go up. Suddenly, the price goes up and hits it, and you get a series of red indicators in the software. That's what we call a sequence, which is in my second book. That is a sign to go short because you've got a clear resistance level to the left. Again here, you see an up thrust, a clear one at resistance. These are very, very powerful signals because what they're doing is encouraging the breakout traders to go long. That's what they're trying to do here. Encourage breakout traders to get long when in fact you should be going short, not long. I hope this is starting to make sense to you. Here, it's the total opposite. You buy after professionals have accumulated, and that's where you buy at point F. And you buy at point F and not at point A, B, C, D, or even at E, because you're still in a downtrend at that point. Wait for the market to start to change behavior. Wait for the market to penetrate point A, and at point F, you've got a trade, a good trade. And you'll see this a lot, this type of activity, as the market turns. And again here, if a market is being what we call absorbed, which we haven't talked about today, but we'll talk about it next week, if the market goes up on high volume, but you see a lot of testing of this level and it refuses to change trend, then at point F, you can take a long trade because you've changed trend and the weakness that's apparent here has not changed the behavior of the market. That means they're going to mark it up further and you can participate in that up move. And again here, this is Amazon. Here's the shakeout, which we learned earlier. We talked about that in part 1. And again, we come down, we test. And all the way on up here, we've got areas to buy this because of the very high volume down here that was immediately tested and has caused this market to go up. And until you see an opposing principle, you can stay long. Now, you will get, when you come outside a trend channel, you will find signs of weakness in the market retracing. You can trade them, but I personally don't. I like to trade in harmony with trend. I'm a trend trader. Here, another example. This is an Australian stock. Shakeout here, change in behavior. Any of these here are very, very good trades to the long side. Okay, that is it for part 2 of the Foundations course. Let me see if there's the questions coming in now. If I've learned this correctly, does it look like a buy on the daily chart of Dell at around the high of the Yao Ming bar on 11.16? We're going to have a look. Yeah, we'll talk about exit strategies next week, Mark. Yeah, we'll come to that. We're actually going to do that live. Well, I'm actually going to trade live with you also. You'll actually see me trade. It's easier to show you live than on a PowerPoint chart. There is a number of things you can do for exit strategies in the Trade Guider program. You can use what we call the trending system, but we'll talk about it next week. Today was really the basics of VSA, getting across some of the key principles to you. And time flies, doesn't it? Look, we've already been together nearly 4 hours. Let's go and have a look at Dell. Okay, let's have a quick look. Okay, so David's saying, if I understand correctly, does it look like a buy on the daily chart of Dell? Yes. There's definitely a shakeout and a test there. Got to be a little careful at the moment because you have got a little mini up thrust there. But if we get any other test here along here, yeah, if I was going to buy this, I'd put a stop in below that bar here. Because you see, let me just be clear, when you see this, there are times when the market will come and retest these levels, but that is a good setup, no doubt about it. You've got a wide spread down, and then you've got a test. There's only one thing I don't like about that. Look at the trend behind us. But that does look to me like someone's coming in and trying to buy here. I don't like it because of I'm a big trend trader. I don't like that trend of price. That's trending down massively. So I probably wouldn't be inclined personally to buy that. But if you wanted a short-term buy, let's have a quick look here on the weekly chart. It's That's a very difficult call, that one. It wouldn't be one I would buy, put it that way, David. It wouldn't be one I would buy because of the trend. It hasn't changed behaviour yet. I would want to see at least 3 of these diamonds green on my weekly chart and beginning to make upward progress. We're not making any upward progress, are we? We're making downward progress, which isn't great. All right, is there any further questions? Any other questions? We've put the link to my book in the second in the room here. And there's also a link to register for next Saturday's session, which I suggest you do now. We will get the recording out to you once we've edited it. So we will do that for you. Any other questions at all? I'll give it another couple of minutes and then I'll close up. Sorry we've overrun a little bit, but okay, looks like we're good to go. Okay, everyone. Well, look, on behalf of everyone here at Trade Guider, from Ken, Richard, and myself, thanks very much for joining us today. I hope you've enjoyed it. I hope you've learned something. I do suggest you go back and re-look at this recording when it's available. I know there's an awful lot of information that we've given you here today, but I hope it makes sense to you. And, you know, most importantly, it takes a bit of study. You've got to put a bit of work into this, but if you do, you'll have this knowledge with you for the rest of your life, and it will be very rewarding for you. Thanks, everyone. Have a great rest of your weekend, and we'll see you next Saturday. Take care. Bye-bye.